right, yo, what is up for everyone who's watching this on the replay? I hope you are having a great Sunday. I want to start the stream off. Instead of doing a stock portfolio update, I want to get into the stocks I actually just bought for the first time ever. I'm actually dipping my toes a little bit into the commodities market. I specifically bought two commodity type stocks. I bought ticker symbol CF, which is a fertilizer play, and I'll show you why. If you're going to own a commodity stock, you want to make sure they have quality fundamentals, and both of these check the boxes. And the other stock I just bought was ticker symbol MLI, Moeller Industries. They do copper, brass, aluminum, like piping products and stuff like that. Both of these companies have literally no debt whatsoever. So let's start this off by analyzing ticker symbol CF and see how they are doing. So this is a fertilizer commodity company, and if you're going to own a commodity company, you want to make sure the valuation's low because commodity stocks usually trade at very low multiples, and they do. They only trade at literally at a 6.7 forward PE, so they only trade at 6.7 times next year's net income. They sell ammonia. Basically, these are fertilizer products for all, food that grows, and they've beaten the past couple quarters on earnings, like the orange lines what the analysts project, the blue lines what they actually report. They had a big beat on net income this quarter. They expected 420, they did 615, and that was a real beat. Like even on earnings before interest, taxes, EBIT, basic EBIT right here, they expected 607, they did 838. So this wasn't some one-time accounting fluke. They genuinely are improving. And the main metric you want to look at is EPS. This is net income per share. I like the per share metric because if a company issues shares, like their net income can stay the same, but if they issue shares, your EPS can go down because there's more shares that exist. Well, it's good to see that even in like the depths of 2023 and 2022, their EPS never goes negative. Like they constantly make a couple dollars of EPS. You get a great dividend yield. You buy the stock now, you get 1.9% of your money back, just an unqualified dividend every year. But let me check the exact dividend yield because I think it's a little higher. Yeah, I did just buy 6 shares of this. Again, for a commodity type stock, it's not the one you want as like the backbone of your portfolio. You just want it as a small size position. And if the war fears and the Strait of Hormuz fears start to escalate, this is to the pure beneficiary of this company. But my absolute favorite part about this stock, bear with me here, is this metric right here. The total common shares outstanding. Look in the bottom left. There are currently, as in 2026 Q1, 153 million shares as of 2026 Q1. Let's go to 2021. So right now there's 153. Just in 2021, there were 214. They've bought back legit over 20% of all their shares just in literally 3-4 years. So I'm very impressed with their numbers here. So that's why I decided to pick up a little bit of ticker symbol CF stock. Should benefit if war fears start to escalate. And also MLI. This one isn't just booming because of the commodity of copper and brass. They actually, manufacture stuff, mainly copper tubing, HVAC materials. I'll show you this right here. Valves. They own a ton of patents and stuff like that. But here's Moeller Industries. They own the only like Canadian full like copper manufacturing plant that like turns it into a bunch of different stuff like HVAC and refrigeration stuff. And so anyway, if we go to their, I just want to go straight to the balance sheet. What takes a lot of risk off the table of this commodity stock is the fact that they have no debt. Look on the top right, they have 1.4 billion of cash. Their cash pile just continues to grow and absolutely no debt. So that takes a lot of risk off the table when you have 1.4 billion of cash and no debt, and the whole company is worth 14 billion. So that's easy math. 10% of the entire market cap is literally just their cash on hand. So they're trading at a 16 PE ratio. You can really subtract 10% off this and do an X cash PE ratio. But yeah, their piping systems, industrial metals, climate. How's their main business? Piping systems at 62% of their business. Check out the growth rate year over year at the very top. It grew 18.89%. That is the fastest growth rate on the entire screen. And the real winner of this company has been the pricing power. And if we just zoom out to the net income, this is what you want to see. No wonder this stock has done so well because the actual profits, the net income has done so well since 2019. They used to make only 28, 30 million a quarter. Now they're easily making over 200 million of after-tax net income every single quarter if you average it out, plus the no debt, and you get a dividend and your 1% dividend, very safe payout ratio, 16 PE ratio. That's why I actually just initiated a position into this company, and they just crushed earnings. Again, orange line's what the analysts projected, and the blue line's what they did. They beat on revenue. They beat on net income by a huge chunk. And I bet you're wondering, is that some accounting fluke, one-time adjustment? Did they really make that? They really did, even on the EBIT. They expected 214. They did 312. Pretty nuts. So yeah, those are the two stocks I actually just bought for the first time the past week or last week I did. So yeah, there's my two little positions. Oh, another stock I've been buying is Netflix. But let me say what's up to y'all in chat. I hope everyone's having a great Sunday. What's up, Vulcan, Prit, and Brian? How's everyone doing? What's up, everyone on TikTok as well? TK, Mo. Is it true the US is in a bubble stage? Here's why it's hard to claim we're in a bubble. I'll give a quick little thesis on this. Here's why. Basically, point being, don't sell your stocks. I really think there's a lot more room for the S&P 500 to rise. If we go to the S&P 500, the main component of the index is NVIDIA. And NVIDIA is, in my opinion, very cheap. Well, not very cheap, but it's cheap. If we go to a valuation, they traded only 19 times forward PE. That is significantly cheaper than the S&P 500. So there's a lot of room. Like, it's hard to claim we're in a bubble. 19 forward PE, in my opinion, that's not peak bubble valuations. Here's Microsoft. This is 5% of the entire S&P 500. Is this one at some peak bubble valuation? I don't think so. A 19.9 forward PE. Google's at like what are they at? Google's at a 26 forward PE. Micron's at like a 13. What's Meta at? A 17. So that's why, in my opinion, the market can easily stretch higher. And kind of the market right now this past year has really been propped up by stocks like hardware, like AMD, Intel. All we need is a little like there's some sectors that haven't been doing well. Think of fintech like SoFi, Robinhood. Think of software like ServiceNow, Adobe. If we can get all of a sudden rally in software and in fintech, I mean, that could be another catalyst to send the S&P 500 just to a crazy new all-time high. One of the reasons fintech stocks have been struggling, like the brokerages like Robinhood, SoFi, is simply because of crypto. If you look at crypto from literally exactly a year ago, it's down over 50%. So RIP crypto, it's actually underperformed over the past 5 years. Every asset, it's underperformed. Silver, gold, S&P, Russell 2000. So unfortunately, it's underperformed traditional assets over the past 5 years, and it's but now could be a decent time to potentially buy into Bitcoin, but I'm waiting until MicroStrategy goes bankrupt because there's over a 10% chance, there's this huge did anyone see STRC? It's like this dividend Ponzi scheme. STRC owned by Strategy. It's supposed to always stay at $100. It's pegged to $100, and it's lost so much faith that it's literally decoupled because this has 1.5 billion of annual dividend payouts, and the only way they fund that is by selling their Bitcoin. MicroStrategy has to. Anyway, Bitcoin's a talk for another day. We're looking at stocks. So what's up? Let's see what y'all got in here. Hey, what do you think of a long-term hold about Micron? So the super long-term case around Micron, you do want to be careful with because kind of think about this. 2027, 2028, that is genuinely going to be peak ever EPS. And then literally for the rest of history, EPS and net income will never hit that level again. So there's this huge RAM, memory, SSD, hard drive shortage driven up by data centers. And basically Micron is the huge beneficiary. Micron forecasts multi-decade memory demand cycle from AI and humanoid robotics, expects tight supply beyond 2027. So again, they just sell total commodities. RAM, memory. It should be a very low margin, but because of this shortage, let's go check out their net margin right here. 57% this quarter, and at this growth rate, you don't want to know what the margins are going to be in a couple quarters. But we can forecast, look at the net income projections. On the very left, it's $5 billion. On the very right, 2027 Q1, this is real after-tax net income. They're going to hit $39 billion in net income, it's never been close to that before. There is still hundreds of percentages of EPS growth for Micron to come still, just in the next couple quarters. That's why you don't value Micron on a trailing 12 months PE. You value them on a forward PE. And when you do that, honestly, it's hard to be bearish when Micron's only at a 7.8 forward PE. I mean, that's not a peak bubble valuation. Maybe this can still stretch up to a 10, 11, 12 forward PE and literally send this up another 40%. But that being said, you just want to think about the thesis again. Total commodity, will the supply chain just fixed by 2027, 2028? It's kind of play off that. All right, by the way, if you're watching on TikTok, I'm actually gonna have to end the TikTok stream soon. My live is not eligible for recommendation, is restricted. Basically, stream just got taken down. Viewers are going to spout to zero. If you want to help me out, the only way to support me, I sell nothing. The best way to support me is just watch the stream from YouTube. Just type in the YouTube Nathan Robert, you'll find the stream. But we'll just stream until viewers go to zero. But hey, what's up, Prit? Yeah, so great picks on CF and MLI. Yo, those are two really cool commodity stocks. Hey, what's up, Free Me? Good to see you, K-Dude. Hey, salute. What's up, We Winning? So, Hot said BKNG. This is a travel play, Booking Holdings, and the valuation honestly is starting to get super cheap. So the risk reward is starting to look very fair. I do wonder why they're struggling though. So here's what Morningstar has to say. Well, here's the valuation first off. They're trading at a 17 times net income. That's very inexpensive. But Morningstar says they're undervalued. An expanding comprehensive travel network, robust integration of AI utilizing their proprietary data, and strong growth in vertical offerings such as payments and alternative accommodations will drive long-term value growth despite near-term geopolitical headwinds. Anyway, they're a money printer. And actually, they have incredible margins, literally like 98% gross margins, and then like a 20 to 30% net margin. I mean, it basically costs nothing to run their website. I mean, if we go to after-tax net income, they easily make well over $1 billion of after-tax net income a quarter, and like $1.5 billion of free cash, or like close to $2 billion of free cash flow every single quarter. Get a nice yield, a 0.9% dividend yield. Honestly, the risk reward is starting to look pretty fair. I do want to see, like, what is the bear case? I don't know if there even is one, but Morningstar usually has one. Okay, here's what the bears are saying. Oh, wow. So bears are saying Google's continued emphasis on placing its paid ads and meta search platform ahead of free organic search links could place market cost pressures on Booking. Consumer could seek large-scale AI language models to help plan their travel, which could increase marketing expenses for Booking. Booking gets a large percentage of bookings from Europe, around 50% of its room night bookers, which could be nearing a more maturing growth phase in emerging markets. So there's the bear case, but I think it's probably fully priced in at this very low valuation. Yeah, anyway, if you're on TikTok and you really want me to analyze your stock, please say it on YouTube. I'm not going to be reading the TikTok chat. I'll look at one or two more on TikTok. But yeah, if you want to help me out, I'm about to remove the TikTok stream. I'm only going to be streaming on YouTube. Please just type in YouTube Nathan Robert. You'll find the stream. Anyway, TikTok took down the stream, so it's not my fault. So here's Super Microcomputer. Someone said, yeah, what's up, TK? This is the company. So if you're a big data center and you order a bunch of NVIDIA chips, you hire Super Microcomputer to come install it for you, put it in your data center, do all the cooling and stuff for you. Supermicro backed, is there any news? So Supermicro launches data center building block solutions for the NVIDIA Vera Rubin platform. So yeah, that's they basically already can install NVIDIA's new chips for you. And here's honestly why it's hard to be bearish. Supermicro trades it in 11.3 times next year's net income. That's like a commodity multiple. Here's the net income forecast. Yeah, they really are supposed to make like 300 to 400 million of after-tax net income a quarter. The only hard part is trusting management. So there's a bunch of bad news. Like right here, the CEO quit this day because they were not just accused, but found guilty of smuggling chips into China to prop up previous net margins. Also, right here, this day, I was a shareholder back here. They were supposed to report earnings this day. They literally did it. It was the craziest day ever. Like we were waiting like at 4:10 for them to report earnings. They just never did. So they definitely have a questionable management team. Dell has really taken market share away from them. They just also diluted shareholders by 20%. So you now own 20% less of the company than you did just 2 weeks ago. So, there's a reason it's trading at an 11 forward PE. Plus margins have kind of come down. They used to run at like a kind of high single digit, 7, 8, 9% net margin. Now, as it's gotten more commoditized, it's like a low single digit. But anyway, at an 11 forward PE, it is tough to be bearish, but you just want to think about the risk to reward there. Henry said, what do you think about ServiceNow? Have a blessed day. Hey, you too, man. Very much appreciate that. And yeah, hey, I want to get to Palantir. I'll definitely get to Palantir. Thoughts on INFQ? What's up, Charlie and Luca and Tama? Appreciate y'all popping in from TikTok. Hey, thanks for coming in. I greatly appreciate that. Yeah, if you got a stock you want to look at, definitely let me know. So here's ServiceNow. It's one of the top software companies. They're on a massive dip right now, and it's because every software company is. Even Microsoft, Salesforce, Adobe, Duolingo, any software stock looks very similar to this chart. ServiceNow rallies as AI software sector gains on OpenAI financial struggles and IPO delay reports. So I guess OpenAI doing bad is good for software, I guess. I mean, hey, they're saying maybe the bear case is you could Claude code, vibe code away, what ServiceNow does. I don't think so. Anyway, Morningstar says they're undervalued. The company's clear leadership in AI monetization, highly successful land and expand strategy beyond IT workflows, and elite customer retention will drive robust long-term value growth. The one metric that does scare me, and the one reason why I would not buy anything meaningful today, is because of this forward PE ratio. They trade at 45 times next year's net income. If we get another big software sell-off, in my opinion, this 45 forward PE can fall to like a 38, 37 and send this down another 15, 20%. So that being said, now's not the time to go crazy in the stock, but maybe it's still a time to buy a small amount of the stock because they do have impressive fundamentals. Check this out, like literally not by the year, but by the quarter, revenue just hits a new record. I mean, it just is super growthy. It's 20% every quarter, and not just revenue, but their net income positive, making a 4 to 500 million of after-tax net income. Unfortunately, again, the 45 forward PE is a little scary, but Morningstar says fair value is 165. They always trade expensive. All right, I know we got a little backlog of stocks, so I'll try and be quick. I'll only do like a minute or two on each stock. I appreciate everyone that's asking stocks and stuff. So here's Inflection. Hey, if you are enjoying, please leave a like. I stream every Sunday this exact same time, and I sell literally nothing. I have no course, book. I'll never follow you, DM you. I don't coach. Literally nothing. Just on here analyzing your stocks, and of course, nothing's financial advice. So here's Inflection. I think this is just some quantum company. I don't think they have revenue yet. Well, let me check because I don't remember this one. Revenue. So yeah, revenue this quarter was 9 million. I mean, we're talking about such small numbers here. Luckily, they just like fortified their balance sheet. Like they used to have a lot more liabilities and debt than assets. Now they have no debt and a ton of assets. So I'm assuming that's from share issuance. Yeah. Whoa, they diluted the shareholders by 550 mil. The whole company, actually, that was probably smart. So they diluted every shareholder by like 30%, but they knew their stock was overvalued when they did that. So I don't blame them. So service revenue, product revenue, no analyst even cover this one. I guess they have 11 million of revenue forecasted and negative 30 mil of, net income on that. So, I just don't know about this one. It's a quantum computing company. I'm sure if like ASTS or RGTI and QUBT start to rally, that one will probably rally too. But I don't know. I wish I had, and again, they just IPO'd. There's only 2 quarters of data for me to analyze there. So I do feel bad. I can't give you too much of an analysis there. USA government take 100 million stake in the company, recently announced. Oh, I think they actually got a $100 million loan. I do remember that the government did this Quantum Chips Act and they invested, I think, like $1 billion into IBM. That's why that stock rallied up. If you really love quantum, I love Google, Microsoft, and IBM as the top quantum players. They have the money and the talent to beat every one of these tiny small competitors like RGTIs. All right. So Young Mar, wait, can you check AVAV post earnings or pre earnings? He says, yeah, let's do it. So they report earnings. Wait, when do they? On July 29th. Wait, no, June 29th. That's tomorrow. So, good luck with this company. They literally report earnings tomorrow. So it's either going to go up or down a bunch. Let's see what they do. They are on a massive downtrend right now. So that's not good. Maybe the market knows the earnings are going to be bad. I don't know. So, substantial revenue expansion and potential for sharp rebound under favorable economic conditions will drive long-term value growth. Morningstar says autonomous systems, space, cyber, and directed energy. Are these like weapons? Like I heard of like DOE weapons, like direct energy weapons that they use. So here's what they sell, I guess. Here's their website is what they sell. Maybe, yeah, those shoot like literal high energy beams. I guess they do components for undersea products, space, cyber. So yeah, I guess that's their industry. It looks like, so they're number 3 in unmanned Anyway, so they do defense, unmanned systems, counter UAS, directed energy, electronic warfare. So some sort of like defense company. Let's check out the revenue growth. Revenue growth is very good. If we zoom out, it's actually at a record. Like specifically the past 3 quarters, the year, like look at these growth rates the past 3 quarters. It's over 100%. I suspect if we look at the balance sheet as well, like from 3 quarters ago, it's actually because of an acquisition. So they bought a company back here for over $1 billion. And that's kind of why the assets out of nowhere just spiked up and the revenue spiked up triple digits. It's part of an acquisition. But anyway, the one tough part is this net income looks like they are losing net income. What are the forecasts? Actually, they're supposed to make 30 million in net income next quarter and only lose 3 million. So they're barely losing any money. They did miss on revenue. So check that out. Analysts projected 475. They only did 408. So that's unfortunate. So all eyes are going to be on their next earnings report. We definitely don't want to see them have a big miss like they did this quarter, because this quarter specifically, they really did have a big miss on revenue and net income. So I guess we'll watch. And again, the forward PE does look revenue driven by Blue Halo acquisition, boosted advanced space and defense technologies. This is the earnings outlook. Profitability declined due to higher integration and goodwill impairment. All right. Anyway, interesting there. Oh, is there any news? Oh, Arrow results due to 90 million goodwill impairment. So anyway, here's kind of some. Anyway, good luck tomorrow. It's kind of like if you buy now, it's kind of betting into earnings, so you definitely want to be careful. Oh yeah, Palantir. Let's do Palantir. And YV said, what app is this? Yeah, this app I'm on, it's actually a brokerage where you buy and sell stocks on. If you'd like to get it, I actually have it linked in my bio there, an affiliate link actually. You can just type into Google Moomoo. If you use my affiliate link, and if you sign up for the brokerage and deposit $100, we both get like a free like fractional share of NVIDIA, I think. Anyway, here is Palantir. This is one of my favorite stocks. I actually just made a video on this one. And hey, dude, Brian Paul, dude, shout out the member. I appreciate you, dude. Good to see you. And I know I'm a little behind. Yo, we definitely got to get to what's up, Alice, and at some and PritPal. I'm a little behind on the chat. I apologize. We'll definitely try and get to all these here. Hey, what's up, Plasma? Shout out to member too. So here's Palantir, one of my favorite stocks. Should just buy, never sell. Unfortunately, they are still just a slight bit expensive, but here's why they deserve to be expensive. Let's just judge them on their fundamentals first. Half of the revenue comes from the government. So many police stations, the military, Air Force all use Palantir. They're actually being protested right now because ICE is actually using Palantir. So that's a negative here. But look at the growth rate of the government revenue. It's up 76% year over year. That's actually the fastest growth rate on the entire screen. So the government revenue's growth rate is growing, and not just the government revenue, but the other half, the commercial side with S&P 500 companies like GE Aerospace and Google, that grew 95%. Like, wow. And that's organic. It's not like they bought some company to inorganically get that. This is organic revenue growth, and check out how they just beat on net income every quarter. Orange lines what analysts project, the blue lines what they actually do. Look at this margin expansion. This is like the DNA of a multi-bagger. Net margin went from 24% to a 54%. You know, net income went from 200 to 800 million, revenues up 85, and a huge, safety net is the fact that they have literally no debt, completely debt free. They have $8 billion of cash. The cash pile grows every quarter. They just earn interest on it. So this is a fortress company. Literally not a single complaint, except that they are still a slight expensive. I don't love a 73 forward PE, but look, here's the thesis. It's currently at 130 times net income. They're growing their EPS by 50% this year. They're going to grow it another 50% the next year, 50% the next year. And, so you do a PEG ratio, price to earnings growth. Add some. This app I'm on is actually linked in the description of the YouTube stream too. But yeah, it's called Moomoo. So next up, what is Tung Tung? Is that a stock? I can't find that one. Hey, Nathan, I bought DRAM calls because you said they're cheap and a good alternative. Well, I don't, DRAM, what is that? Is that the ETF? Oh, yeah, anyway. Yeah. I would definitely, I don't know about calls on the memory stocks right now. But yeah, basically, if you don't know which individual memory stock to buy, if you've heard of this memory RAM shortage, like you've heard of Micron and SanDisk and Samsung, you don't know which one to buy. This ETF breaks your money up for you into all of the top memory stocks. And you can't get exposure to Samsung individually because they're not public. Well, you can get them exposure via this stock, and same with SK. So yeah, and they have the Japan holdings. Yeah, this is a cool one. Ticker symbol 285A. That's the Japanese stocks. Always got weird ticker symbols. This is a Japanese ticker. They've done phenomenal as well. Anyway, it's an ETF. It's maybe a more disciplined approach is just to just buying one single one. So what's next here? Can you check out BMO stock? What is BMO? Sure. Bank of Montreal. Oh, cool. So can we see your portfolio? Yeah, I do a ton of stock portfolio updates. Actually, I have not covered my portfolio yet this entire stream. I went straight to stock analysis. So you know what? After this, I'll do a super quick stock portfolio update for the people that care. So here's BMO stock, Bank of Montreal. All the Canadian banks have done amazing. And it's actually not just the Canadian banks. If you look at a JP Morgan, a Goldman Sachs, a Morgan Stanley, all of these as well are nearly at an all-time high. So the banking sector has been phenomenal. And what's cool is they don't just give you good stock price appreciation. Like check that out the past year. A year ago, this was $95 a share. Now it's $175. They also give you very nice dividends. Oops, what did I just click? If you buy shares, even after this huge rally, even though it's doubled, you buy a share today, you still get basically 3% of your money back just in a qualified dividend every year. Is there any news? Canadian banking regulators cut capital buffer to 3%. Okay, so they have like this reserve ratio. That's good. Down from 3.5. Okay. This releases approximately 74 billion in capital cushion, equivalent to 673 billion expansion and risk. Anyway, I guess that's good news for the banks. Moody's rates capital buffer reduction as credit negative for Bank of Montreal. Anyway, stock's at an all-time high. They don't have to keep as much reserves. So here's my quick portfolio. I see Oracle as well. Yeah, hey, I'm actually, what's up? Yo, burner mail, Dr. Andrew. Hey, I forgot. I'm no longer looking at the TikTok chat. I'm only streaming on YouTube. If you want to support me, best way to support me is watch the stream from YouTube. Type into YouTube Nathan Robert. But anyway, here's my quick portfolio. This is my buy and never sell account where once I buy a stock in here in the top left, I'm literally not allowed to sell it. That's why we've actually done so well in this portfolio. Like year to date, I can't believe it. We're up 69%. Over the past year, we're up 140. All time in here, we're up, I think like 300. Yeah, 350%. We put like 17 grand in here and now it's worth 50K. this portfolio. That's been our best portfolio by far. Our other portfolios have not done so hot. We also have a Webull portfolio right here, open profit and loss. I'm up 32%. Again, I go to a ton of other streams and YouTubers. No one shares their entire lifetime performance on their portfolios, their lifetime P&L on all their stocks. I love being fully transparent with all that. We also have a Robinhood portfolio. I know I got way too many portfolios and way too many stocks. I know. This is in the top left is called my dividend only portfolio because every stock in here pays a dividend, and most of these are just all S&P 500 companies. The only stock we're down on here is McDonald's right now. But yeah, Google's been our best performer. United Rentals has been very good. It just passed our McDonald's position. So yeah, our largest holdings are at the top. And I'm looking to buy more Meta because they're at a 17 forward PE. We also have a Roth IRA. Roth IRA is just a tax-free retirement account. We only have 4 stocks in here. Keep it in simple. So anyway, if you want to learn more about my stock portfolio, I do a ton of videos about my whole entire portfolio. What's up, Brian? He says lasers. Hey, is that a ticker symbol? So stocks said, I've been DCing into Netflix. I feel it's undervalued. That is one of my most recent purchases. So let's go over at Netflix really quick. And hey, what's up, Plasma and Rogers? Yeah, stocks, bro. We'll look at and Markers or Marks, dude. Shout out to member too. Hope everyone's having a great Sunday. We'll look at AIoT and Circle after this. And O'Reilly, what's up, Larry? O'Reilly Auto Parts. I like them more than AutoZone actually. So here's Netflix stock right here. If we head over to my Webull portfolio, here are all my most recent purchases in their exact order. So literal, my third most recent purchase, there's my buy order right there. I actually just bought 2 more shares of this company at $72.29. Netflix was up 4% on Friday. Netflix, I think the risk reward looks very fair to nibble. Like if you want Netflix as 5% of your portfolio, don't make it 5% of your portfolio today. Only make it like 1%, like 0.5 to 1%, and only buy more once it falls 5 to 10%. That's what you really want to do in this high volatility market. It's a more disciplined approach. But anyway, here's why the risk reward is already fair to go ahead and start that nibble because I don't really see it getting much lower. Like I couldn't imagine my Netflix at like an 18 forward PE. So yeah, they traded a 22 forward PE or only 22 times next year's net income. That's cheaper than the S&P 500. They used to disclose this. It's actually way higher now. But back in 2024, when they disclosed their metrics, they had 301 million premium subscribers, and they literally made $11.69 in average monthly revenue per paying membership. And if you didn't know, they just rose prices by $2 a month. So in my opinion, they have pricing power. Like they just rose prices by $2 a month. I don't know about you guys, but we're not canceling our subscription. And if we just zoom out, like this is what you want to see if you're just going to buy and hold a growth stock, where the revenue just continues to hit a record like every single quarter. It's a subscription model company. It's all reoccurring and stuff. I know they're sometimes being boycotted and stuff, but all I see is a company that prints money. I mean, if we just zoom out to the net income over time, I mean, they're the most profitable they've ever been. And we can see that trend up over time. They're easily making like $3 billion of net income a quarter. Same with free cash flow, like $2.5 to $3 billion of free cash flow a quarter, and they only trade at 22 times forward PE. So that's why, in my opinion, I just bought Netflix. And if we look at the net income forecast on the left, it's going from 2.55 to 3.59. There's still more EPS growth from Netflix to come. So next up is Meta undervalued. Wait, let me go to, I got to scroll up here. AIoT, and remind me to get to Circle too. And O'Reilly, I'm so behind. I got to be quicker here. What's up, Mr. Phil? And what's up, Ice and Charlie and Street Beater? What's up, everyone? So you just earned a sub. Hey, I appreciate that, Street. So here's Powerfleet right here. I've actually never heard of this company before. Unfortunately, if we zoom out like on the monthly, the stock has not done too well. It's actually the same prices they were back in the year 2000. So unfortunately, the stock has it doesn't pay a dividend either. So since the year 2000, it's literally done nothing. So they do services and products. Most of the revenue are so North America, then Africa, then Israel. So it's like an internationally diverse company. The revenue forecasts are bad. Look at this. The revenue is supposed to fall to 34 million and then 70 million. I don't know about this company. So they're a software infrastructure company headquartered in New Jersey. Provision of fleet management solution for logistics, industrial, and vehicles. Wireless Internet of Things, machine solutions. Anyway, this might just be a commoditized industry. I have no clue. They are technically making profits, but then when we go to net income, it's negative. I don't know. I'd just be really careful with this one. What's the market cap? The revenue so the whole company's only worth $501 million. When a company has such a small market cap, you definitely want to be careful. Like $500 million company, and they're forecasted to lose $2 million and then only $18,000 after that. But revenue decline, I don't know. So let's do Circle right here. Circle again. This is a cool crypto play, but I think the reason they've done so bad is because of just actual Bitcoin. If we zoom out to Bitcoin over 1 year ago, literally a year ago, or since 1 year ago, Bitcoin has fallen over 50%. So of course these crypto adjacent stocks like Circle is also probably not going to be doing too well, but they're probably more hedged because they are a stablecoin play. They have a 28% stablecoin market share. They literally own USDC. U.S. Congress set to ban Federal Reserve digital dollar until 2031. Guess that's bullish for this company. That's great. While the ban eliminates potential government competition for stablecoins like USDC, the practical impact is limited as the Fed was not close to issuing a CBDC. Okay, any other news? Let's just go look at their fundamentals right here. And do we get an earnings breakdown by chance? USDC ecosystem expanded with 28% increase in circulation to 77 billion and a 263% surge in on-chain transaction volume growth. Net income declined 15%, mainly from increased stock-based compensation after the IPO. Okay, anyway, let's go look at the revenue growth. How fast is their revenue growing? Well, okay, revenue's going very fast, actually. Wow, revenue is up 20% this quarter. Last quarter grew 76, and then 65, 53, 58. So they're on a streak of growth, and they're technically making net income every quarter. And the net income forecasts look good too. They're supposed to make 50 mil next quarter, 55 mil the quarter after. So they really are supposed to stay net income positive. So the only bad part is the valuation of a 72. So they traded 72 times next year's net income. That might be a little too expensive. But if you want exposure to like stable coins, like Morningstar says they're undervalued, robust revenue growth. Wait, did they actually give a real analysis on USDC? Nah. Anyway, a cool crypto adjacent play. I think Bitcoin doing bad might also be why Circle is struggling a bit. But honestly, if we see a huge recovery in Bitcoin, that might send that up. So O'Reilly, let's do O'Reilly right here. Then I'm going to have to skip a few, and I'm just going to go to the most recent kind of ones on the screen. STRC has a 14% yield. Yeah, what's up, iStog? That one's being questioned. It's actually being called a Ponzi scheme right now, dividend trap. I'll actually kind of go over that in a minute here. That's actually hurting Bitcoin too. So here's O'Reilly Auto Parts. They got a really catchy like slogan. They are off their peak right now. It went from 109 last year to 89 right now. But I really love the buybacks this company does and the valuation. So they trade at 26 times next year's net income. And let's just zoom out to EPS, which is net income per share over time. As we could see, it grows very fast. I mean, at a really good rate. What's it been recently? Yeah, still double-digit EPS growth for the past, 4 quarters in a row, 16, 12, 12, 11. So it's good to see double-digit EPS growth. I wonder how the buybacks are doing. So yeah, they don't pay a dividend. The way O'Reilly really returns money to the shareholders is by buying back their own stock every year. That's why the stock is crushed the S&P 500. They usually buy back like 4 to 5% of all the shares a year. And instead, like they could choose to pay a dividend. They could pay you 5% of your money back in a dividend every year. They choose to maximize shareholder returns by only doing share buybacks. That's why the stock never goes down. Same with AutoZone as well. I actually like this one a bit more than AutoZone. But yeah, basically this should benefit from, as the economy does bad, people don't buy new cars when the economy is bad. They spend money fixing up their old cars. And that is to the pure beneficiary of O'Reilly and like an AutoZone. So anyway, hopefully that was kind of helpful there. They actually kind of do good in bad economies. Happy to follow here as well. Hey, thanks OC Pet. I appreciate you. So next up I saw, the real quick thing about STRC is I would not buy this for the dividend. So they have a $1.7 billion annual dividend obligation. So they have to pay $1.7 billion a year in dividends to fund this. It's supposed to peg at $100. It's literally never supposed to leave $100, but there's been so much sustainability questions that it's decoupled and fallen 25% from its peg. So mainly because there's now prediction markets, simple prediction markets are projecting over a 10% chance of MicroStrategy going bankrupt or Strategy. And that's what owns STRC. MicroStrategy to what's this right here? They have a huge unrealized loss right now. Strategy discloses first Bitcoin sale since 2022. They had to sell Bitcoin to fund the dividend of STRC. Strategy holds 850,000 Bitcoin with over 13 billion unrealized losses. Strategy cash reserve decline as dividend obligations surged to 1.7 billion annually. Peter Schiff accuses MicroStrategy and Michael Saylor of misleading investors, calling STRC a Ponzi scheme. Lawsuits are launching investigations into Strategy over disclosure practices. Look at all the bad news here. My goodness. Analysts warn Strategy may need to sell over 50,000 Bitcoin as leverage model faces scrutiny. That's exactly that. I'll buy Bitcoin the day MicroStrategy goes bankrupt. Have you done Uber? I have 2 shares. I have not done Uber yet. I also saw Grab. You know what? This is a way to play Grab because Uber's the largest shareholder. This is another one of my most recent purchases. If I go over back to my Webull portfolio right here, literally not even that long ago, there's my buy order right there. I bought 12 shares of Uber, and I've just been holding on ever since. It's one of my new favorite stocks to just buy and never sell. I think it's worth having as a small percent of your portfolio, not financial advice. The risk reward is looking very fair, and here's my thesis on them. I know they're saying robo-taxis are going to hurt this company, but first off, Uber's already on a massive downtrend and trading at like 18 times PE. I think those fears are fully priced in, and I'm actually a believer Uber's going to benefit from robo-taxis. Look at that. Uber commits $500 million to self-driving startup Nuro, total autonomy spending. Uber expands criminal background check disqualifications for US drivers. I guess that's good. Changes are expected to remove 0.5% of Uber's active workforce, affecting tens of thousands of workers. The company faces over 3,000 lawsuits from passengers. I guess that's not good. But check this out right here. If we go to Uber's valuation, this is why I think it's hard to be bearish. They're trading at let's do a forward multiple because they had a one-time adjustment to their trailing 12 months EPS. Even when we value them off next year's net income, they're only trading at 20 times next year's EPS. Check out this metric right here. Their monthly active consumers, so not just monthly active users, but people consuming it, grew from 170 to now 199 million. So obviously they have ride-sharing mobility. The main growth driver recently has been delivery. So this is Uber Eats, and also they're getting into B2B, business-to-business delivery. That grew 35% year over year at the top. That is the fastest growth rate on the entire screen. So it's like the growth rate's growing over here. So that's why, I don't, and also autonomous vehicles like Waymo might hurt Uber. It's really the platform where you go to book the autonomous vehicle that makes the money. So yeah, look at Uber's revenue over time. Just hits a new record by the quarter, double-digit revenue growth, and same with net income as well. Look at that. They're the most profitable they've ever been the past 4 quarters. 2020, it was a hard buy, and they were still losing a couple $100 million a quarter. Now they're making over $1 billion a quarter by far. So and again, 20 forward PE, 199 monthly active consumers. Morningstar says they're undervalued. Robust network effects from its massive global user base, expanding operating margins, and scale-based efficiencies will drive long-term value growth. They also own a ton of stakes in a bunch of different companies. Like someone mentioned Grab, Uber was having a tough time expanding internationally. If we go to right here, shareholders of this company right here, Uber is the largest shareholder. They own 13% of this stock called Grab. This is international Uber. They do the exact same thing that Uber does, but look, notice US, Canada, UK aren't on here. That's the market Uber dominates. So it's like Malaysia, Singapore, Indonesia, Philippines, Thailand, Vietnam. So that was a good way for Uber to get that international diversification. And they also own a bunch of other stakes in a ton of other stocks as well. Some of their investments I don't like they own Lucid stock for some reason. All right, so is Meta undervalued? Let's do it. Meta stock, I actually do believe they're very undervalued. SoFi, oh yeah, we'll do SoFi after this. Wouldn't do Circle. Best in low interest rate environment. Yeah, hey, what's up, Street? Yeah, Bitcoin's struggling too right now. Then we'll do Nebius as well. I know, my bad here. NUTX, what's up, Charlie? So here's Meta right here, huge advertising behemoth. So right now, Meta is being sold off about fears around their CapEx spend. They're saying Meta is spending way too much money on AI, and they don't have a cloud. They don't really have a successful LLM. So what justifies them spending $35 billion a quarter on CapEx? Meta launches Kylie Jenner branded smart glasses, commands 85% market share. Yeah, dude, I'm a believer. Meta's the first to do it. I love this division. They have literally an 84% smart glasses market share. I believe Google and a ton of other companies, like Apple, are going to get into the smart glasses. Meta was first. Google imposes usage caps on Meta's Gemini AI access due to capacity constraints to sign a $920 million monthly computing capacity agreement. Interesting there. Meta launches 299 AI-powered smart glasses in partnership. Yeah, Meta to deploy Qualcomm processors. All right, anyway, let's go look at their fundamentals right here. The bad news is they're spending $35 billion a quarter, and they only make 20 to 24 billion a quarter. So right now they're spending more than they're making. So Meta has a net debt position for the first time ever, but that's not scaring me at a Meta. I'm a believer that AI is going to make their return on ad spend, and basically their ads are going to be more profitable. If we go to the revenue growth, we already kind of hinted that at this quarter. Revenue grew 33%. That's faster than all the other Mag 7, and it's the fastest growth rate in years Meta's had. So 33% revenue growth rate. And they just disclosed that. So they have an app called Threads. It's like an X competitor. It now has 500 million monthly active users. They're introducing ads on that site. They're introducing ads to WhatsApp. So anyway, I'm not being this high capex isn't scaring me at a Meta. I think the fears are fully priced in, especially at a 17.5 forward PE, only trading at 17 times next year's net income. Here's a cool metric. They have 3.54 billion daily active users. So pretty much half the world is on a Meta app once a day. And if you didn't know, China's not allowed on any Meta apps. So, and that's a huge chunk of the world's population. So honestly, ex-China, like 70% of the world's population is on like a Meta app once a day between Facebook, Instagram. They just disclosed their average US Facebook user. If you're a US user of Facebook in the US, you make Meta $50 a year. Their ARPU is $50 a year per US Facebook user. Okay, SoFi stock right here. This is one of my favorite fintech stocks to buy now. Not financial advice, of course, and I do own SoFi, and I did just buy another share. I bought another share at $15.50. Again, not one you want to have as a major size position, but maybe go ahead and have it as a small size position. So check this out. Here's what I love about SoFi. They are a growth behemoth. Morningstar says they're fairly valued. Its unique full-service digital banking model drives significant cost advantages and switching cost, but elevated credit risk exposure and reliance on capital market demand for loan sales warrant caution. Okay, so what they're talking about is basically back here, SoFi issued or diluted shareholders by $1 billion, but then they went, that's just what they do. They issue money or issue shares to raise money, and then they go loan it out. And if we go to their lending business, this is what justifies that. Their lending business grew 55% year over year. That's the fastest growth rate on the entire screen. It's like their growth rate's growing on their lending business. And also same with their financial services, the other half of the business. Check out the streak of growth here. It's up 41% year over year. After grew 101, after grew 85, after grew 244, after grew 264. Like they're on a streak of growth. And that's what justifies, me buying the stock. And if we zoom out to just both of the businesses combined and we just go to total revenue right here, revenue hits a record every quarter. Like by the quarter, revenue hits a new record, and not just revenue. So we want companies that make revenue, but also companies that make profits and net income. SoFi checks that box as well. They make a couple $100 million in net income a quarter. And check out the future forecast. It's never been close. It's supposed to grow to $237 million in 2 quarters. There's still a lot of EPS and net income growth still to come to SoFi. So you really want to judge this one off a forward PE, because right now they trade at 39 times net income. Again, you value this one off next year's net income because they're growing their EPS so fast. They're only at a 25 forward PE. That's where the risk reward starts to look very fair. And I suspect SoFi as well is really down bad over the past year because they do get a lot of money because they have like SoFi USD and stuff. They do get some money from, because they have a brokerage, crypto transactional revenue, and that's down bad year over year simply because Bitcoin is. If we go to Bitcoin from 1 year ago exactly, it looks kind of like SoFi stock. It's down 50% plus. So if Bitcoin starts to rally, I think that would be great news for SoFi and Robinhood and some of these other stocks. So, oh gosh. Have a great day, Nathan. Talk later. Hey, see you, Larry. Appreciate that. So, I was meaning to get to this one. Nebius stock. So that's an NVIDIA holding. So if we go to the NVIDIA portfolio right here, NVIDIA is owner of that company. So NVIDIA owns Intel, CoreWeave, Nokia, and then they own a little bit of Nebius. They own Nebius because Nebius is one of their biggest customers. Basically, NVIDIA gave them a bunch of money and took a stake into them just for them to spend all of that money strictly on NVIDIA chips. Basically, if you're wondering what does Nebius do, this is the one part of AI I'm a little bit cautious about and not going to actually buy. It's the GPU rental business. Basically, Nebius owns a ton of GPUs and then rents them out. Morningstar says they're overvalued despite near-term revenue momentum, the massive multi-billion-dollar cash flow burn required for data center expansion, and the highly sensitivity to GPU utilization rates in a rapidly advancing hardware market require extreme caution. Because there's this huge depreciation thesis. They have like $30 billion of chips. They'll need to be depreciated in 5 years from now. Everyone wants the newest chip. So if we go to net income forecast, this is the real reason why I wouldn't buy Nebius. Just net income forecast, and they had a total one-time accounting fluke this quarter. They didn't actually make 600 mil. They actually lost 300 mil, but they had a gap one-time adjustment making them look like they made money. Next quarter they're supposed to lose 223 mil in net income. Then the quarter after they're supposed to lose 305 million. Like the net income losses are worsening year over year. So this is the GPU rental business. It's not just Nebius I'm picking on. You can look at CoreWeave. You can look at Iris Energy. You can look at Keel. You can look at Core. You can look at any of these GPU rental companies. They all have so much negative net income forecast. It's a total commodity. And that's the one part of AI I would not want exposure to, the GPU rental business. I'd rather be the one selling the GPUs. Like an NVIDIA, that's the real picks and shovels play, because they're going to come out with the new chip and all the older chips, well, GPU hourly rate prices are going to plummet. That's why yeah. Hey, what's up? Captain Obvious said UPC stock. Let's check it out. So this is Universe Pharmaceuticals. So okay, we're actually not going to cover this one. If you look in the top right, they're only worth 1.6 million. I'm sure someone in here is worth more than this whole company. You could buy the whole company for $1.6 million. I believe, yeah, it's a pharmaceutical company with no revenue. Or let's see, do they have revenue? Revenue? Okay, so they did 17 million for the full year 2025, and they lost 4 million. When the whole company is worth 1.6 million, losing 4 million is pretty devastating. Yeah, don't buy that stock, please. I don't think the market cap is so low. So let's do NUTX now. Yeah, Nutex Health. Actually, this one's on my watch list. Sorry, get my water here. So here's Nutex Health right here. They've actually had a phenomenal past year. Looks like they gapped down back here. Now they're like gapping back up. They were up 11% on Friday. Let's see what this company does. So they're at a very cheap forward multiple, only trading at 7.3 times next year's earnings. Oh, that's kind of in line with the hospital group. So basically, I'm assuming they own a bunch of hospitals. So yeah, medical care facilities is the industry that they're in. Let's see. So they own 27 quality care facilities, 10 plus upcoming facilities, and they're in 13 states. The hospital division and population management division. Okay. Owns and develops innovative healthcare models, including micro hospitals, specialty hospitals, and hospital outpatient departments. 27 facilities. Anyway, so we can kind of 27 hospitals or whatever. Let's see how that runs. So they really do make good net income every quarter. So like at least it's never negative. Like 67 mil, 16, 96, 16. What are the forecasts? Yeah, they're supposed to make 35 mil next quarter, 36 million the quarter after. So they're really supposed to make well over like 30 million in net income a quarter on average from now on. So I do notice like the revenue specifically spiked up. I wonder if they did like an acquisition back here, because like the revenue out of nowhere like spiked up triple digits. So I'm assuming they bought some new properties back here. But anyway, it's really tough to be bearish at a 7.3 forward PE. I'm personally a huge fan of the hospital industry. I actually own HCA Healthcare. They are the largest non-governmental owner of hospitals in the world. I'm down 12% on my position. Hey, I got a small little dividend, $5.69 dividend coming in from them. But they're also very cheap. They're at a 13 PE ratio too. But I am down bad on them, kind of. Interesting company there. Hey, what's up, Looney? So if Meta can lead future in AR, VR, they're golden. I agree. I love I believe everyone's going to get into the Meta Ray-Ban glasses. Do you have any ELF stock? I actually do not own ELF beauty stock. By the way, Alsho, if you're on TikTok right now, I'm ending the TikTok stream right now. Go to YouTube, type it in YouTube Nathan Robert if you'd like to keep watching, and I'll analyze your stock over there. Sorry, TikTok took down the stream, but thanks again, YouTube Nathan Robert. All right, so next up, I see, oh yeah, ELF right here. This is a beauty and cosmetics company. They are kind of down bad from 1 year ago. Just 9 months ago, they were $150, and now they're $67 a share. What's the valuation? So this is the one tough part. Even on this massive downtrend, like even on this huge dip, they're not exactly a steal of a deal. They're trading at 34, they're 35 times next year's EPS. That's still a little expensive, especially when you compare that to like an Ulta Beauty. Looks like they missed on their actual net income this quarter. Analysts projected 6 mil in net income. They lost 49 mil. And unfortunately, it looks like it was real. Like even earnings before interest taxes, they expected 33. They lost 31 million. So that was a slight bit odd, but I love the revenue growth. Like they're a growth behemoth over time. Like check that out. 2023, they were doing like 100 mil a quarter. Now it's like they're doing 400 to 500 mil of revenue a quarter. But that 35 forward PE does look a little, would be cautious. Morningstar says they're undervalued. While it's attractive enterprise, okay. Is that even real analysis? Okay, yeah, they don't give like real detail on it. But anyway, also, I also really like Ulta Beauty. So as we saw this quarter, Elf Beauty lost net income. Elf Beauty lost some money. Well, here's another beauty stock that's also on a massive dip. You know, they were just $700. Now it's 480. They are a money printer. If we go to net income right here, like every single quarter, they're easily making a couple hundred million of after-tax net income every single quarter. They buy back their shares like crazy. Here's a quick way to tell. Net income grew by 11. Net income per share grew by 15. How did the net income per share grow faster? Well, it's because that's the per share part of the ratio. They bought back 4% of the shares, so the EPS grows 4% faster than the net income. And you get a nice dividend, I think. All right, so FISV just got a new CEO, and the top 10 insiders just bought a ton of the stock. Do you think I should jump in? Let's check it out. FISV. Is that Fiserv? Wait, FISV. Okay, you have Fiserv stock right here. So I remember this is like I think a consulting company. Let me just double check because I don't know. Okay, so merchant and financial. Huh. Oh yeah, I remember back here. I remember covering this one. Like their merchant transaction, like volume fell by like 40% or something, and that sent the stock down. It's just been down bad ever since. Anyway, Morningstar, the valuation's an 8.6. Actually, the forward PE is slightly higher than the trailing 12 months PE, so that means their net income is expected to go down. Does Morningstar give coverage? The bulls are saying bank technology business is very stable. Ongoing shift toward electronic payments has created and will continue to create room for acquirers. But the bears are saying since it was built through acquisitions, Fiserv has maintained multiple core processing platforms, which could limit margins. Fiserv's bank technology operates are tied to a mature industry and almost entirely domestic, which limits growth. Due to the First Data merger, Fiserv is now more exposed to macroeconomic conditions. Huh. I mean, even if analysts are right, I mean, look, they're still supposed to make 710 million next quarter, 840 million the quarter after. But it looks like there was a big miss like 2-3 quarters ago on the very left there. Yeah, big miss on revenue. They expected 5.35. They only did 4.9, and they missed by like a couple hundred million on profits. Oh, so yeah, this is the bad part. So we go to revenue. It's a whole margin compression issue. So revenue fell by 2%, but net income fell by 32. What that means in English is a margin decline. Basic metric here, gross margins are down by 9, net margins are down by 31. Now it starts to make sense why the stock has fallen so much, but at the end of the day, maybe these fears are fully priced in at an 8.6 forward PE. I don't know. Maybe it could be, I definitely wouldn't go crazy, but it may be as a super small position. Hey, what's up, Looney? Yeah, we have not looked at Microsoft yet. Let's definitely do it. So Microsoft, if you haven't looked at them, can you give me 200? I wish. GPU renting, what do you think of GRC? Okay, we'll check these out in a second. So this is another one of my most recent purchases, and I genuinely believe, not financial advice, Microsoft is one of the best stocks to buy. I have a really good pitch on Microsoft I think you'll like. All right, so let me see if I can get this. Okay, let's try this right here. All right, so here is Microsoft stock right here. This is the world's #1 software company. And if you look at any software stock right now, like an Adobe, a ServiceNow, whatever, all software stocks are down bad. So if we go to Microsoft, 42% of the revenue is the software suite. Think Excel, PowerPoint, spreadsheet, all that. Those software suite does 120 billion of annual revenue for Microsoft. So that's a real fear. If AI, Claude Code really takes over and makes spreadsheet obsolete, that'd be really bad for Microsoft. But honestly, I first off don't believe that. I think Microsoft is going to integrate Copilot and make their software better. But also, Microsoft is the most hedged out of any software stock on a dip. Microsoft is the best positioned because they literally own 28% of OpenAI. So if OpenAI really takes over, Microsoft is hedged as a huge owner. And also, not just that, if AI really takes over as well, their cloud business will continue to boom. They're the second best play for cloud. Number one market share is AWS. Number two market share is Azure Cloud. That business also does over 100 billion of annual revenue for them. And then they have these other businesses like they own Minecraft, they own Xbox, they own LinkedIn, and they own Microsoft Surface. And right now there is some bad news because, Microsoft raises Xbox. Yeah, they own Xbox, raises Xbox console prices by up to $150, citing AI-driven memory demand. Expect the new iPhone to cost $299 more. This memory shortage is causing margins to compress at a lot of these companies. And, it's like Microsoft will try to raise prices on consumers by $150, but consumers just won't buy Xboxes as much if it's going to cost $150 more. Actually, I just bought about 8 months ago, I bought a new Apple laptop. Right now, I just checked, I could sell it more than when I bought it brand spanking new, that laptop I just bought. It was a MacBook Air. I could sell it more because they actually just announced they're raising MacBook Pro prices by like another $150 because of this memory shortage. Anyway, that aside, Microsoft's is steal of a deal, not financial advice. Here's their premium subscribers, their Microsoft 365. They have 82 million subscribers, and the valuation is so cheap. They're trading at a 19.9 forward PE. I don't believe it. Like, I don't see Microsoft going lower. Like a 15, a 16 for Microsoft, I don't believe it. So the bottom, in my opinion, is very close. If it's not here, it's 5 to 10% lower at most, and not financial advice. So in my opinion, you literally can't go wrong buying Microsoft with a little bit amount of money. I don't think any financial advisor would call you crazy for, out of all the stocks that exist out there, people buying crypto and all this like micro caps, just if you want to buy a stock on a dip, buy a quality one like Microsoft at a 19 forward PE. Morningstar says they're undervalued. Robust demand for Azure driven by hybrid cloud and AI workload alongside its highly entrenched Office ecosystem will drive long-term value growth. So if you want exposure to Xbox and software and cloud and AI, check out Microsoft. It's one of the best ones, I think. All right, so what do you think about GRC? It's a US-based pump business. Let's check it out, GRC. Let me know if you're talking about this one right here, Gorman-Rupp. Wow, they're at an all-time high today, so this must be some sort of AI beneficiary company. So yeah, congrats if you've ever bought this stock. You're definitely up on your position. Let's see here. So design, manufacture, and sale of pump and pump systems. That's very interesting. So specialty industrial machinery is kind of their model here. I bet you, specialized pumps, who doesn't need these? Like houses, like residential people, who probably needs this are the C&I customers, the commercial and industrial company. And I bet that's why they're doing so good because housing spend and interest rates are so high, no one's spending on houses. So the residential part of a ton of companies are doing terrible. But I bet you this company right here has a lot of commercial and industrial type customers. Anyway, marketing of pump and pump systems, self-priming centrifugal, standard, submersible, rotary gear. Okay. Fire protection. All right. Products. Let's go check out their fundamentals here. So if we go to revenue, let's zoom out. So revenue's been pretty decent. I mean, the growth has slowed down a little bit. Like if we kind of go to the growth rates at the bottom, it's kind of single digits, 7, 2, 2, 5, 3. So kind of low, mid single digit growth, but they're very net income positive. I mean, they're definitely the most profitable they've ever been. This quarter specifically was a record net income. So they're growing their EPS like crazy. That's what's probably led to the stock price appreciation. That being said, though, I would still be careful because of the 33 forward PE, trading at 33 times next year's net income. But it kind of seems like an AI-proof business, Can't get an LLM to do what they do. $2.36 billion company. You know what? I'll put them on the watch list. They're very niche. I like that. Pump company. There's another like super investor that loves, what's it called? I think it's this guy right here. He owns Comfort Systems as well. Oh, yeah. Ranpak Holdings. What is this? Oh, that stock's done terrible. I don't even know what that company does. All right, let's see what's next. Just joined. Can we look at Microsoft? So sorry. Oh, no. Hey, Joey. Actually, we just looked at Microsoft. Nice. Yeah, hey, if you want, you can like rewind the YouTube stream. So, hey, what up, Norbero? Good afternoon. Cosmetic brands come in and out of fashion. Ulta sells different brands. Yeah. That's the kind of one thing about like clothing stocks too. Like trends change, like 10 years ago, remember the what are those memes? Like everyone wanted Nike shoes. Now it's like, who cares what kind of shoes you wear? Like people love Hoka and QC and like so many other brands have taken market share away from Nike and Lululemon as well. Amazon has specifically come for Lululemon. Amazon specifically now has a 17% clothes and shoes market share from their own Amazon Basics brand, selling these high quality like leggings and stuff. All right. So anyway, Norbero says UNH. So check out United Healthcare. Oh, and I see SNEX and DRAM and some of these other stocks. What app is this? Yo, what's up, ATR? I'm actually on a brokerage. It's where you buy stocks on. I have it linked in bio there, LinkedIn profile if you want to check it out. Or you can just type into Google Moomoo. But my affiliate link's up there. And if you sign up with that link, we both get like a fractional share of NVIDIA if you sign up and deposit $100. So United Healthcare announces $3 billion AI investment, targets $1 billion in cost reductions. Anyway, this stock has been so much in the government's hands. As we can see, like they're still flat from like, well, let's see, if we go to the weekly chart here, they're still the same prices they were back in 2021. But basically back here, they were accused of overbilling the federal government and kind of prescribing patients with the back brace they didn't need just for money. And they're very in the government's hands. Like the reason they gap down on certain days when there's no earnings report day, the reason they gap down or gap up is because of the government either allowing them or not allowing them to raise their Medicare, Medicaid prices. We're actually a customer. We use OptumRx. How's that doing? This just OptumRx does 154 billion of annual revenue. Their main United Healthcare does 350 billion of annual revenue. But recently, let's see, is there any other news? No. If analysts are just correct, if analysts are right about the forecasted net income, honestly, it's not even too terrible of a deal at a 23 forward PE. Like they're supposed to make 4.1 billion next quarter, 3.1 billion the quarter after. We definitely just don't want to see them miss because like they did that last quarter. They only made, and that was real as well in operating profit. They only made 300 million of net income. That doesn't even cover the dividend. The dividend costs 2 billion just itself. But if they can really just make 3 billion, they're fine. I don't know if I'd buy them after this huge exorbitant rally though. Actually, I would not buy them after this huge rally. But yeah. Next up, what stocks have you talked about to buy this week so far? Just joined. Hey, what's up, Joey? So yeah, the few stocks that I think are pretty decent to buy this week is kind of some beaten off sector stocks. Like I really like Netflix, Uber, and Microsoft. Those are like the best to buy, not financial advice. But there are some other good ones. Like I actually just bought MLI, Moeller Industries, probably a stock you never heard of before. Yeah, what app is this? Yeah, hey, again, I'm on a brokerage. This app I'm on is LinkedIn bio, LinkedIn profile there if you'd like to get it. So, in your opinion, when will the AI bubble pop? Not till a long time. On my opinion, we're still very undervalued. The S&P 500 is undervalued. The main components can easily climb higher. The main components of the S&P, like Microsoft, Meta, Nvidia, Google, they're all undervalued and a cheap forward PE. These are not peak bubble forward PEs, So here's StoneX stock. I've actually not, well, they're on my watch list, so I've analyzed them and something impressed me. They're at an all-time high, so they do commercial, whatever commercial stuff they do. It's up to a record 44 bill of revenue, up 23% year over year. Wow, look at the net income growth. So revenue grew 24, net income grew by 143. That means pricing power and margin expansion. Anyway, yeah, look at that. Analysts projected to 121. They did 174. So it really was a good beat. And on revenue, they beat on revenue, they beat on net income, EPS. So they're in capital markets, commercial hedging, global payments, securities, physical commodities, clearing and execution services. So with access to 40 plus derivative, oh geez, my background changer is gonna make that impossible to read. Anyway, seems pretty interesting. It's probably it's a high barrier to entry market. Does Morningstar cover them? Fortunately, Morningstar does not cover them, but very interesting there. Oh, it looks like a Middle East and Asia kind of stock exchange. So this isn't like a US capital markets company. Looks like it's mainly in the Middle East because that's 91% of all their revenue. So there you go. It's like an international like stock exchange, like capital market kind of thing. All right, so next up I see, hey, what's up, Paul? He says PGY stock. Yeah, let's do PGY. And then we'll do data center cooling systems. Yeah, I love HVAC. Instead of just owning, NVIDIA, own the whole entire ecosystem, in my opinion. Own the companies doing the HVAC work, the heating, ventilation, air conditioning. Own the companies doing the MEP work, the mechanical, electrical, plumbing work. Own the companies powering these data centers, like with CEG. CEG is the largest purist play for nuclear energy. They power over 30. They own over 33% of all the U.S.'s active nuclear reactors. Purist play for nuclear energy. So, and you can own the companies providing the copper cables, like Amphenol. Anyway, let's get to PGY right here. This is Pagaya Technologies. I think it's some like financial services company, software company. They're very cheap valuation. Let's go to their website right here just for, yeah. So when you use them, you approve more loans and retain more customers using the Pagaya network, all with no additional credit risk. So they're partnered with like Ally, US Bancorp, and I think SoFi as well is a customer. So what's their, so yeah, you're basically, you keep more borrowers, retain more customers, build loyalty. Anyway, financial stocks use them, and a lot of financial stocks are struggling because of Bitcoin is. But yeah, the revenue growth did kind of slow down this quarter. It's the slowest growth rate they've had in a couple years. The revenue only grew 5.7% year over year. So revenue's up 5.7, but they still print net income, easily making like 20 to 30 million of net income a quarter. And look at the net income forecast. They're really good. They're supposed to make 32 mil the quarter after, 39 million of net income after that. So when we do a forward PE ratio, they only legit trade at 8.6 times next year's net income. That just seems very fair to me. Tough to go wrong. It's such a cheap valuation, but I suspect why this one's also struggling is because they're like every software name, like a ServiceNow, Adobe, Microsoft. A lot of software is struggling right now. All right. Oh, Oracle. What's up, William? So Oracle stock. Yeah, this is like your fourth purest cloud player. So number one cloud is AWS. Then it's Azure Cloud, then it's Google Cloud, then it's Oracle Cloud. And in my opinion, Oracle's like the purest cloud play because with Amazon, Microsoft, Google, you get a bunch of other advertising and other businesses. Oh, yeah. Oracle, the bad part about this one is the debt burden. Oracle faces concern over $130 billion debt burden and heavy AI infrastructure investments and make negative free cash flow. So yeah, they're spending a lot more than they're making. Basically, it's a huge strain on free cash flow. If we go to basic metric, FCF, which stands for free cash flow, look at this free cash flow burn. Like they lost 2 billion, 11 billion, 10 billion, 300 mil, 3 bills. So they're losing a ton of free cash flow. That's because they're spending a whole lot more than they're making. So look at this. On like every quarter, they're spending like 15 billion in CapEx. They only make in net income 3 to 4 billion. And 1.5 billion of this is just paid in a dividend. Actually, they pay, this is a crazy thing. So they're at a 22 forward PE. Honestly, Microsoft is cheaper. You can get Microsoft's cloud business cheaper. Google's at a 26 forward PE. Amazon's like a 26. I'd rather just go with any of those three than Oracle. But here's the thing. Since they have 130 billion of debt, they have to pay interest on that. And their interest expense is now $1.15 billion. So look at that interest expense over time. So they pay $1.1 billion a quarter just in interest, and they pay a dividend as well. They pay $1.5 billion in dividends a quarter. So yeah, they made $4.3 billion, but go ahead and subtract $1.5 billion from this because they have to pay a dividend out of this net income. So they're not left with as much net income to pay off the debt as people think. So the leverage is what scares me over here on this one. I know they have a big OpenAI backlog. Like OpenAI has committed to spending over 100 billion on Oracle, but that's why they're spending so much right now to basically fulfill that order. But I would just get my cloud exposure elsewhere. This is like a pure cloud play. And Microsoft's cheaper. And I think it's a better cloud play. So, but I mean, I'm not bearish on Oracle, but I mean, they're at a 23 forward PE or 22 forward PE, and you get I don't like the dividend from this company. You get a 1.4% dividend. If you buy Microsoft, you get a 1% dividend. But, yeah, do we get their backlog number here? Oh yeah. So actually it's right here. It's actually way higher than I thought. Remaining performance obligation, which is contracted backlog, totaled 630 billion. So that's ridiculous. They have 630 billion in orders that haven't been fulfilled yet. All right. Hey, if you're on TikTok, I'm ending the stream right now. Go to YouTube Nathan Robert if you'd like to continue watching the stream. Sorry, TikTok is just screwing me today. All right. Oh, what's up, member Brian Paul? What's up, dude? He says G and RC. Let's do Generac real quick, and then we'll get back to NOK. Oh, what's up, Hurricane? We'll do Nokia up over 40% on UNH. Thinking of selling some. I think that's smart, Norbero. Maybe do a slight nibble. Or I mean a slight trim. Definitely don't fully sell out because the forward PE still has room to grow. But I wouldn't call you crazy for selling a little bit and maybe moving that over into a better sector. So here's Generac right here. This actually does good whenever there is a hurricane, whenever there's a tornado. A bunch of people go and buy generators and rent generators from Generac. So it's used, but the tough part is it's residential. Or that's half of their revenue right here. People like you and me buying it. So it's really cyclical. Like actually, if we go to the annual basis right here, look at that. It was actually higher. Like this segment of business is much higher in 2021, 2022, and it's kind of been flat ever since. But the real growth driver leading to the stock price appreciation, if we look at Generac the past year, the reason they've done so well is not because of the residential side, But the commercial and industrial side, the data center companies, this business year over year grew the fastest on the entire screen. It grew 28% year over year. Very impressive. 510 mil of revenue. It's never been close to 510 mil of revenue for one quarter before. It's really this commercial industrial business sending the stock up. What's the forward PE? So it is a bit of a tough sell of a forward PE, a 36 times next year's net income. But anyway, what a lot of companies are doing is they can't connect their data center to the grid, so they just bring on-site generation. Maybe Generac's a beneficiary of that. But the forward PE does look a little questionable. So let's do Nokia. Yeah, Nokia. This is actually a holding in the NVIDIA portfolio right here. So if we go to NVIDIA's portfolio, NVIDIA owns Intel, CoreWeave, and then Nokia. It's 5.3% of their portfolio. They've had a great year. Like 1 year ago, they were $4.50. Now, even on the slight dip, they're $13 a share. Still a very good performance. I don't think any investor would be disappointed. The main metric that's sending Nokia up, the main reason they're doing so good, it's not because of their smartphone business. As we know, in the year 2000, this was a $55 stock. Now it's $13. They lost the smartphone war against Apple, but the war, or the industry they're now in, is called AI and cloud. If you look at the second line right here, this AI and cloud business sales increased by 49%. That's a very fast growth rate, generating 1 billion euros in new orders, significantly boosting their profitability. So that was the main little financial metric that sent the stock up, or it's really sustained the momentum the past year. Morningstar says they're overvalued. Structural headwinds from mobile equipment commoditization and intense pricing pressures from capex-heavy telecom carriers do require caution. So yeah, 39 forward PE does. I would agree. I would be certainly cautious, especially after this huge rally. Yeah, 39 forward PE. But I did like to see that growth of the AI and cloud business, and check out the future forecast in net income in US dollars, because this is a European company. We've converted the currency to US dollars. They're supposed to make 266 mil next quarter and 380 million the quarter after, but they have missed on net income the past 3 quarters in a row. So, but if they can beat next time, that'd be great. So yeah, that was kind of Nokia. Would still be cautious, but that AI growth was good. So MCID said, UEC stock, yeah, this is uranium company. This is one of the companies, they bought a uranium mine off Rio Tinto like a long time ago, which is another stock I really like. So anyway, here's Uranium Energy right here. They still don't have too much revenue and they don't have a forward PE. So that's the one part that's like, it's tough to trust. They don't make any net income and they're not expected to make any sort of profits anytime soon. Yeah, here's the net income right here. This is the bad news. So kind of for all of history, they'd lose like 10 million a quarter. They have a fortress balance sheet though. So that's the one good part. There's no risk in them going bankrupt. They have, look at that, 500 mil of cash and literally zero debt on UEC. So, the revenue did spike up. So look at that. 1 year ago, they had no revenue, 100K, 116K. Now it's 17 mil, 50 mil, 20 mil. So the revenue is starting to come back, it looks like. Forecasts are still tough though, like 9 million, 5 million. Yeah, I actually would be really careful with this one as a uranium play. There are some other uranium plays I like. You can also just buy the whole uranium ETF, ticker symbol URA. It almost looks identical to the chart of the stock we just looked at. But my favorite uranium stock, if I genuinely just had to pick one to buy and hold forever, I pick CCO, Cameco, the very best uranium play by far. Where is LEU? LEU is another one. Sprott Physical. Anyway, also another part of the uranium industry I love is Solstice Metals right here. So they just IPO'd not that long ago. And even on this rally, they're at a 30 forward PE. Not crazy expensive, but here's why. If you genuinely are a believer in nuclear and uranium and the future of it, here's what's so cool about Solstice. If my thing would load here. Okay. Check out this, check out the third line right here, or I'll make it the very top. Check out the very top line here. This company owns the only uranium conversion operation in the US, which will see higher sales from growing nuclear power generation in the coming years. So the raw uranium is converted into fuel via Solstice. So like a LEU sends the fuel over to Solstice, they refine it into fuel for nuclear reactors to use. Because that's if you don't know what nuclear reactors are powered off of. Hey, what's up? Oscara said, thoughts on APH stock? Yeah, that's one of my holdings in this portfolio. It's in my buy and never sell account because I literally plan to never sell this company. This is the company that provides NVIDIA and Google with copper cables. So it's a copper cable and fiber optic supplier for chips. That's why the stock has done so well. It's the IT, datacom, big tech clients that are buying their stuff. Morningstar still says they're undervalued. Massive demand from AI infrastructure investments for its best of breed data center connectors, combined with a flexible, decentralized operating model, will drive long term value growth. And even after this massive rally that Amphenol's experienced, they're only trading at a 30 forward PE. Here's why that's fair: 30 times next year's net income. I mean, I wouldn't buy today, but this isn't peak valuation. That's why even Morningstar says they can go to 180 or 190 and it's 160 today. I still definitely agree that there's a lot of more upside room for this company to come. Their main business right here, communication solutions, which is 60% of the whole business. Check out how fast this business grew. It grew 87% year over year. Oh, well, okay. There we go. It grew 87% year over year. That is the fastest growth rate on the entire screen. Like, it's up 87%. Last quarter grew 78, 96, 101, 90, 40, 30. Incredible growth. Also on their next biggest segment, harsh environment solutions, that grew 33, also the highest growth rate. And interconnect and sensor systems, that's up 25%. Basically, I have no complaints about this stock. We go to their profits. This is the net income over time. It's at a record this quarter specifically. So that's pricing power. When your revenue grows 58 and your net income grows by 82, that means your margins are expanding. Anyway, probably is a tough buy close to this all-time high level, but here's where I've been buying it at. I've been raising my cost basis. Every time it gets to this like $128, $135 level, that's when I tend to, I kick, those are my buy orders. Those are what those Bs are. I just continue to buy this stock. And look at my cost basis. My cost basis is way down here. Here's when I originally bought my shares at $60. My average cost basis still is $71 a share, but I continue to buy shares and raise my cost basis at $130 a share because they're undervalued at $130 a share. A lot of people are scared to dollar cost average. They never want to raise their cost basis, but I don't mind doing that and continuing to build out my positions, even though, because I know they're still undervalued. Which app is this? Hey, what's up, Dash? I'm actually on a brokerage. It's where you buy and sell stocks. They ask for a lot of information. If you'd like to use my affiliate link, I have it linked in my TikTok bio profile there, or you can just type in a Google Mumu. But yeah, if you want to get this brokerage linked in bio there. Keel, yeah, we're not really going to cover Keel. This is another, basically same thing as Nebius, same thing as CoreWeave, same thing as Iris Energy, same thing as APLD. They are a GPU rental company. They own a bunch of NVIDIA chips and rent them out. Not the part of AI that I'm a big fan of, but they should probably do good through the end of the decade. But the net income forecasts are just so bad, and not just on Keel, but on everyone. Even CoreWeave, Nebius, Iris Energy, the net income forecasts are terrible. They all are supposed to lose a ridiculous amount of money, so where you can't trust them. Like if we just go to net income on Keel right here, they're supposed to lose 45 mil next quarter, 42 mil the quarter after, but they're always losing more than expected. Like they're losing like 140, 60, 80. So anyway, not one I trust. And look at the revenue forecast. Look at that. I thought the revenue would increase. No. Look, the revenue year over year is going to go from 83 to 30 mil. So revenue is going to decline, and net income losses are supposed to worsen by 4x. I don't know why this stock, it's having what I call like undeserving momentum. And this is the kind of rally that gets faded off really quick. I wouldn't be surprised to see that one tank very soon. There's no fundamentals to justify it. And that's kind of what we're doing on the stream. We're looking for companies with great financials, great fundamentals that really justify their high valuation. Like, let's see what's next. Confused said, "Hey, what's up? Good luck." Someone said AMBA stock, Umbrella, and then we'll look at Alibaba. What stocks have you been buying lately? Ooh, good question, Tom. We'll check that out after this, and we'll look at some other ones. What's up, Joey and John? Do you have a lithium play? I actually do not. Good question. Yeah, I don't have a lithium play. All right, so let's see. Umbrella stock, they are a $2.7 billion company. I just joined. Did I miss Microsoft? Yeah, we already analyzed Microsoft. If you don't mind, you can head over to the YouTube stream and kind of rewind it a couple minutes and find it. But maybe if you remind me in like 10 minutes, we'll reanalyze Microsoft again. Anyway, here's Umbrella stock. I have a really good pitch on Microsoft. I think it's one of the best buys. So Umbrella stock is the same prices they were back in 2014. So that's one thing you want to be very careful with. The stock has done nothing for over a decade. Morningstar says they're reasonably valued. While the company demonstrates excelling revenue growth, persistent lack of profitability and high valuation warrants caution. Oh yeah, look at that. They still haven't made money yet. Oh yeah, so they basically, oh dang, so they used to make money back in like 2017. They used to make net income. Now they just lose a bunch of net income every quarter. So that's one thing you want to be cautious with. But I do notice they are narrowing their losses, so maybe in a few years they'll get profitable. But there is no forward PE. It is kind of tough to value this one because, yeah, they still don't make money. Developer and sale of low-powered AI processing video and image. I don't know what that is. I don't know if it's a commoditized industry either. So semiconductor equipment, facial recognition. Umbrella stock. We just want to see this one make some actual money. Revenue growth looks decent though. Actually, not really. It's not up too much from 2022, and it's kind of cyclical and choppy. Yeah, anyway, I would just be cautious with that one. Yeah, I wish I could give you better analysis on that one. I've never heard of that one before. The thoughts on what's up, Joey? He says, oh, wait, no, I said I get to Baba. So this is basically Chinese Amazon. If you've heard of AliExpress before, this is the company that owns it, Alibaba. And they also are they're a Chinese ADR. So obviously, Xi Jinping can just say anything, tank their stock. So that's, China is really a lot uninvestable. Alibaba sues U.S. Department over Chinese military company designation. Oh, yeah. The U.S. government put Alibaba onside a list of military conflicts. So, yeah, the U.S. government put Alibaba as like a security risk. Alibaba Semiconductor Capital. Alibaba launches Happy Horse video generation model. Anthropic accuses Alibaba of large-scale AI distillation attack on Claude model, using 25,000 fraudulent accounts. Alibaba plans to sell gaming unit. Anyway, what's cool is their cloud business. So obviously they own AliExpress, and AliExpress is basically Chinese Amazon, but it's not like business to consumer. AliExpress is more business to business, where it's like e-commerce, Shopify people buying a bunch of stuff in bulk from Alibaba, then selling it and drop shipping it. But one cool business that they have is their cloud business. It's actually very fast growing. Look at this. So obviously there's like Amazon Web Services. This is basically, that's why I say they're Chinese Amazon, because they also are the number one like Chinese cloud company. This business grew 45% year over year. So their cloud intelligence grew 45% year over year. Nice little growth. And we have converted the currency, by the way, to US dollars, just to get a better idea of what they do. And here's their net income. It's a little choppy, but it is consistent. Like they are still making 2 to 3 billion of after-tax US dollars of net income every quarter, and they really only traded a 17 forward PE. But you still want to be careful because it's Chinese. Morningstar says they're undervalued. Full stack AI capabilities, accelerating cloud revenue growth, highly monetizable network effects with its core e-commerce ecosystem will drive long-term value growth, is what they say. And you get a 1.15% dividend. Interesting here. Any other news around Alibaba? Nope. Well, that's an interesting story there. What made you pick Powell when you did? Hey, I actually have a YouTube video when I first bought Powell Industries. I originally, I didn't feel great about buying this stock either. Look, there's my buy order. That's the only time I've ever bought shares. Would you buy a stock like after it's like they gapped up here, gapped up here, gapped up? Would you buy a stock after this huge rally in just 1 year? Well, that's what I did, and they just continue to win. So sometimes, actually, some of my best performers have been the stocks I bought close to all-time highs. But anyway, I bought Powell Industries because at the time, I bought this one at a $900 million market cap. They were a $950 million company with no debt, $350 million of cash, and they were trading at like a 28 PE ratio. So I'm like, it just had the DNA of a multi-bagger at the time. Definitely not a good buy now at a 48 forward PE, but they still have no debt, print net income, margin expansion. And I didn't even know about the AI beneficiaries. Then they got the reason the stock has really been sent up is because they just got their biggest order ever, a $400 million for one data center order. That's not just installing a few switchgear solutions. They do all the complex MEP work for data centers and the electrical work and the switchgear solutions. And they have these power rooms where they inflate. These power rooms are very prone to setting on fire by a little spark. So they pump the room up with this certain gas to make it impossible to catch on fire. They have so many patents and stuff. Anyway. All right, what app is this? Hey, what's up, Chicha Boom? This is actually a brokerage to rebuy and sell stocks on. If you'd like to get it, it's actually linked in bio, LinkedIn profile there. It's a affiliate link, or you can just type in a Google Mumu. But yeah, it's my favorite brokerage to buy and sell stocks on. Someone said, what happened to NVIDIA? I went on holiday to see it and just to see it go down so much. Well, check it out here. NVIDIA, I believe you definitely don't need to worry about. How do I get myself a star when I want it? Hey, what's up, General Black? Oh, hey, that's for the YouTube members. That's why there's a star next to their name. But what's up, General Black? Um, okay, so here's NVIDIA right here. Here's why it's also tough to be bearish on the S&P 500. This is the largest component of the market. It's like 8% of the whole S&P 500. They trade at a 19 forward PE. That is not peak bubble valuation. People worrying about like bubble fears and stuff. We're nowhere near a bubble at this valuation, at 19 times next year's net income. You know, they're raising their GPU market share. This is the picks and shovels play of AI. And look at the net income over time. If another company can pull off this sort of net income growth, they also deserve to be worth the world's largest company by market cap. You get a 0.5% dividend yield with NVIDIA. It's just not one you want to be worried about. Look at the net income forecast on the very left. It's 31 billion net income. It's going to grow to 57 billion on the right. So that's why we value this one off a forward PE or next year's EPS. And when you do that, they're only at a 19. Morningstar says they're undervalued. It's entrenched leadership in data center AI infrastructure, propelled by its proprietary CUDA software ecosystem, and robust demand for its next generation Vera Rubin, chip will drive long-term value growth. So yeah, there is some competition fears. Let's actually go to the news. I know like Amazon is now selling their own TPUs. That's why I own Amazon, but that's not something you need to be worried about. NVIDIA GPU rental prices decline over 30%. Oh, I guess that's maybe not good for CoreWeave or something. GPU rental prices decline 30%. Commits to returning 50% of free cash flow to shareholders. Wow. I wonder, they already rose their dividend to 0.5%, which is good. Yeah, NVIDIA replaces Apple as top weighted stock in Russell 1000. NVIDIA launches. Anyway, NVIDIA is also so big, they own some individual companies. So if we go to NVIDIA's investments down here, obviously they own a bunch of Intel. They're up over like 7x on their Intel investment. They also own CoreWeave and Coherent, Nokia, Synopsys, Nebius. So they're cool. Great never sell company. Also, yeah, basically what I was saying about why I don't think we're in a bubble and why the market can probably easily climb higher is the top, here's the S&P 500. The number one holding is NVIDIA. And we just saw is at a cheap valuation. 5% of the whole S&P 500 is Microsoft as well. Microsoft is on a massive downtrend and is only trading at a 19 forward PE. That's not bubble valuations. Google is trading at a 26 forward PE. Meta is trading at a 17 forward PE. Like well over 10% of the weighting of the whole S&P 500 are stocks that could easily go up 20, 30, 40% just on valuations alone. And what we've really seen is the S&P 500 being propped up by hardware. Stocks like Intel, AMD really sending up, like Micron, sending up the S&P 500. What's really been struggling is software and fintech. If we now see a software rally and a fintech rally, that could be the catalyst we need to just crazy send the market up next roaring 20s. So that's why I'm really still bullish till the end of the decade. Valuations don't seem ridiculous. Some stocks definitely are way too high, but not on a lot of the main index components. Hey, what's up, my music? World Free Speech, what's up, man? He says, time to start accumulating Bitcoin and XRP. A lot of people, look at Bitcoin right now. Bitcoin is just being worried because of MicroStrategy, Michael Saylor. There's actually, the prediction markets have a 10% chance of MicroStrategy going bankrupt this year, which is unfortunate. They have like a huge unrealized loss on their Bitcoin holdings. So anyway, but the cool thing about Bitcoin is they don't report net income. They don't report earnings, so they can't miss on net income. It's kind of like a cool catalyst-free asset. But I actually personally own no Bitcoin. I own no crypto at all, actually. But the way I get my crypto exposure is via the fintech stocks. That's why I've been saying it's better to buy Robinhood and SoFi on a dip than buy Bitcoin, because these brokerages, they make a ton of money from crypto transactional revenue. They really follow what Bitcoin does, but I've always been a believer that these brokerages like SoFi, Robinhood are going to decouple from Bitcoin and rally up even faster than Bitcoin when they rally. And that's exactly what's been happening with Robinhood. SoFi, I think, is a really good deal too, but that's the reason they've been beaten down. What's up next here? Looney aren't worried about the Iran bombings. Oh yeah. Hey, what's up, LP? Yeah. War fears, if as a hedge to the war fears, you can buy like an aerospace and defense company. And I did that a couple months ago, or about 2 months ago. I was looking for an aerospace and defense company. I ended up buying Moog after a huge rally, and they've just gone up ever since. I can't believe it. So like a Raytheon, a Lockheed Martin, these could be some good ways. And commodity stocks, that's another way I kind of just hedged myself with some commodity stocks like MLI, Moeller Industries, and CF. It's a fertilizer play and a copper piping play. These are plays I've kind of just recently been adding in. All right, so next up, all right, we'll look at. I sadly have to go in 35 minutes. I'm having so much fun. What's up? No way. We got like 50 people on the YouTube stream. Hey, if you're enjoying, please leave a like. And I stream every Sunday this exact same time. If you want to help me out, I sell nothing. I promise. I have no course book. I don't coach. Just on here giving my opinion. So next up, I see big lawsuit on the way for Palantir. They've been spying on American citizens. Yeah, so Palantir is in a lot of heat right now. They also I love the fundamentals. And yo, way, Valnor, dude, thanks for all the no way, I haven't even been checking TikTok. I apologize. Thanks for a bunch of the gifts. I didn't realize we have 100 people on the TikTok stream too. Thanks for all the lightning bolts and the boxing glove. Palantir right here. This is one of the best buys in my opinion. But let's see, is there any weekly news? Palantir and Zeta form partnership. U.S. Army selects Palantir as cloud data layer. ARK purchases $3.3 million worth of Palantir. Palantir experiences worst monthly decline since 2021. Michael Burry closes half of his short position. Michael Burry highlights Palantir decline as broader sell-off. Oh gosh, we got... Anyway, so yeah, there's lawsuits around them, and they help ICE. So that's one reason why a lot of people just won't own this one. They their government revenue, some of their government revenue comes from ICE. They help out them, which I'm not they shouldn't really be getting into that. But anyway, the military, so many police stations use Palantir. The government revenue grew 76% year over year. Ridiculous. It's up 76%. After grew 45. After grew 16. That's why I still love this company. That's why I think, it's honestly, it might be worth putting on the watch list and potentially looking to buy soon, because they really do grow fast. Not just the government, but the commercial side. This is with S&P 500 companies like Google and GE Aerospace that also grew the fastest on the entire screen. It grew 95% year over year. After grew 33, after grew 26, after grew 15. Like the growth rate is growing. And that's what I love about Palantir. Oh, and they crush analyst projections. So the reason Palantir is falling recently is not because they've been missing on earnings. Here's what the analysts project every quarter, the orange line. Notice they beat every quarter. The blue line's what they actually report. They beat on net income every quarter. Margins are expanding. Like, look, revenue's up 84. Net income grew 302. That means in English, pricing power. So their net margin went from a 24 to a 53 in just 1 year. So for every $100 that comes in, they keep $53 after tax. And another thing that takes takes a lot of risk off the table, a huge safety net, is the fact that they're debt free. They have a monster balance sheet. So that's why I have nothing bad to say about Palantir. The only reason why I suspect they're trending down right now is because even on this little downtrend, they're still quite expensive. On a forward PE basis, they're trading at a 73. So what that means is they trade at 73 times next year's net income. That might still be a little pricey, but they currently trade at 130 times net income. Here's the thesis. They're having like this year's 40% EPS growth rate. The year after, they're going to grow EPS another 40% and then another 30% the year after. So you really do a PEG, a PEG ratio, price to earnings growth. Morningstar says they're undervalued though. The continuous penetration of its best-in-class ontology framework in the U.S. commercial markets and its highly sticky government business will drive long-term value growth. There you go. Is there any bad news? Palantir's end markets are confined entities that co-scale with Western ethos. Okay, anyway, they are a beneficiary if war starts to escalate. War fears and stuff start to escalate. They will definitely benefit from that. All right. Hey, what's up for everyone? Next up, I see, oh gosh, I'm really behind here. Oh, Broadcom. I see actually 3 people said Broadcom. Yeah, let's do Broadcom, AVGO. So this is one of the best semiconductor plays in my opinion. And honestly, I'd put them on your watch list, not financial advice. They help Google make their TPUs. Let's see, I know there was some coverage on that right here. OpenAI and Broadcom unveil Jalapeno custom AI chip with 2026 development target that's actually being made by Broadcom. Yeah, OpenAI and Broadcom unveil Jalapeno custom chip. So Broadcom's making their own chip. But look, JP Morgan reaffirms overweight rating on Broadcom. It dismisses the Google TPU delay report. So there's been a little reports emerge of potential Google shift to MediaTek for TPU supply from Broadcom. Anyway, as we know, right now, as this second though, Broadcom does supply Google with a lot of their GPU components. But that may be changed in the future as they try to diversify suppliers. But here's why the risk to reward looks super good. They traded a 60 PE, but look at the forward PE. It gets cut by more than in half. That's because their net income is growing by over 100%. Here's the net income forecast. This is all you need to know. In 2 quarters, they're going to make $15 billion in net income. In 2 quarters. If we zoom out, the net income has never in history been even close to 15 billion before. So there is still massive triple-digit EPS and net income growth rate for Broadcom to come. So that's why you value them off next year's EPS, a forward PE, and they're only at a 27 forward PE. And if we go to their main semiconductor solutions, which is 67% of their business, the growth rate's growing. It grew 78% year over year. And again, the growth is not done. Why don't you own any Broadcom? I just am already happy with my current portfolio, but I'd happily own Broadcom. It's not like I'd sleep very well at night owning this stock. And you get a nice dividend, a 0.7% dividend that they raise every year faster than inflation. So it's like a dividend growth stock. Morningstar says they're undervalued. It's a commanding market leadership in custom AI compute chips, surging infrastructure demand from cloud hyperscalers, and highly reoccurring free cash flow from its deeply embedded enterprise software will drive long-term value growth. Yeah, they own the VMware business as well. Which if we go to an annual basis as well, look at that, 2023 full year was 7.6 billion. Then in just 1 year, it grew 180% to 21 billion, now 27 billion. So both businesses I love on Broadcom. And I wouldn't be worried about that Google TPU news potentially switching some of their supply to MediaTek or whatever. So I love under the radar ones. Oh yeah, me too. That's the kind of stocks I like to buy. Like I feel like every stock on here really, except for Amazon, like it's like a hidden gem stock. I really feel like, or like stocks that no one knows about. Next up, and I do have like some I really like right now. My most recent purchases have been MLI, CF, Netflix, Uber, Microsoft. Oh, and AbbVie just hit an all-time high. Yo, does anyone remember? I've been pitching this stock for like years. I've been saying if you want a stock with a high dividend yield and still get good stock price appreciation, get AbbVie. You get a 3, and I'm glad they've been doing so well. Anyway, let's see what's next here. Sorry if I'm a little behind and missing some stocks here. I'm a beginner investor. How do I know if it's the right time to enter tech stocks? Honestly, historically, the right time to buy stocks is just always be buying. The S&P 500 is 8 to 10% a year, and it's done that for all of history. So the best way to beat the market is to just buy the S&P 500. And then, I would pick and choose some of my own individual stock names. But yeah, I would say Broadcom is starting to look pretty good. I don't think the bombings will create a drop like the initial news of the war. Yeah. Let's see what's next here. Broadcom is my largest holding. Hey, nice there, my music. Yo, you got a quality large holding there. These pullbacks seem like a controlled tempering of the market, slowly removing hype. I've noticed, has anyone else noticed this? Every pullback we get, every sell-off, like recovers so quickly. Like we never get like a real sustained dip. Like we had the tariff one that lasted like a month and a half, and then we've just been up ever since. We had another dip down here, just got fixed. We had a dip down here, we recovered. So honestly, like the administration will just tweet something and save the market for you. Yo, I love the analysis. Yo, Josh, dude, good to see you, bro. I love your videos. All right, so next up, I see Nebius and Intuit. All right, let's do Intuit right here. They own TurboTax, QuickBooks, and basically they're seeing a decline in TurboTax. These DIY tax filers are no longer like using Intuit as much, unfortunately. And this is just one of the basket of stocks that is being hurt by AI. Maybe they're saying in 10 years from now, you can just AI Claude code your taxes away. But with taxes, it's a bit of a sensitive thing. You don't want to mess that up. And so maybe you just don't want to use AI to handle all your taxes. But actually, did we get the breakdown here of the earnings? So yeah, where was this right here? We don't have to look at that. The forward PE is very cheap. They traded a 14.4 forward PE or 14 times next year's net income. Morningstar says they're undervalued. High switching costs within its core small business accounting software and the expansion of AI-driven assisted tax filing. Oh yeah, AI-assisted tax filing. That could be a huge beneficiary of them. So yeah, look at this. TurboTax faced material headwind or could face material headwinds if the government-sponsored free tax filing program gains traction in the U.S. So government-sponsored free tax filing program, that's kind of like a new thing. Intuit Enterprise Suite is still in the early stages of build-out process, requiring continued investments. Small business accounting software competitors like Xero are looking to expand in the U.S. market, leading to stronger competitive pressure on QuickBooks. All right. Intuit's done-for-you products like TurboTax Live, given the company's additional runway, lift average revenue per customer. Anyway, I really like Intuit, but you do want to be cautious in this software sell-off environment. Like if you want Intuit is like 5% of your portfolio, don't make it 5% of your portfolio today. Only make it like a 0.5 to 1% size position. But I can see why you would want to go ahead and nibble on it because the 14 forward PE, like at this point, like we know the AI fears, is it fully priced in at this point after the stock has fallen 60%? I mean, how much more can it fall? I don't know. But yeah, it looks like consumer. So that might be the bad part, the consumer part of the business, the DIY, like retail customers. But the net income forecasts look good. You're supposed to make 200 mil, 500 mil the quarter after. So there's no chance in them like going bankrupt anytime soon. So yeah, and you get a 1.8% dividend yield. You buy the share right now, you get 1.8% of your money back just in a dividend. Wow. So from your opinion on Keel, highly likely tanking in the future, is it possible? Also, yeah, I am not a fan of the GPU rental business. Let's also want spam and Nebius stock. I'll be quick. Let's analyze Nebius real quick. NVIDIA does own them. That doesn't mean you should. And the only reason NVIDIA owns them is because NVIDIA gave them a bunch of money just for them to go and spend all that money back on NVIDIA chips. So if you're wondering what does Nebius do, to keep it simple, and it really is this simple, they own a bunch of NVIDIA chips and rent them out. This is a GPU rental company, so they do the exact same thing as CoreWeave and Keel and Iris Energy, and it's just not a profitable business. Here's what Morningstar says: they're overvalued despite revenue growth. The massive multi-billion-dollar cash flow burn requiring data center expansion and the highly sensitive GPU utilization rates and a rapidly advancing hardware market require extreme caution. Exactly, because when NVIDIA makes their new Vera Rubin chip or new chip, it makes the GPU rental hours and all the other stuff for the previous chips go down by a bunch. Anyway, they also had a funny money accounting trick this quarter. It says they made 600 mil this quarter. They didn't actually. They lost 300 mil. But look at the forecast. They're supposed to lose 220 million the quarter after and then lose 300 million the quarter after. It's basically they're nowhere near net income positivity. They're actually, the losses are going to be worsening by 3x year over year. So that's the only scary part. They probably will do good just off NVIDIA momentum because, NVIDIA owns them. But it's just the one part of AI that I don't want exposure to, the GPU rentals. It's just not profitable. And it's not just them I'm picking on. It's every single GPU rental company. I would not own CoreWeave either. It's not just Nebius that's going to lose money. Look at the net income forecast on CoreWeave. They're supposed to lose 700 mil next quarter, 600 mil the quarter after. They already lost 740 mil this quarter. And you can go to Iris Energy as well. They all are big money losers because it's a pure commodity. Do you think Webull will get profitable soon? Hey, what's up, Plasma? Let's check out Bull. I do have a brokerage with Webull. They're publicly traded. So like, here's Webull, the app, and then here's their stock right here. So yeah, let's check out how the net income is. So yeah, dang, they did lose 20 mil in net income this quarter. Or actually, technically, they only lost 2 million. That was disappointing. I thought Webull was going to stay net income positive because of their prediction markets. Actually, analysts project that they're supposed to make 5.6 million next quarter, 11 mil the quarter after. So they technically are supposed to stay net income positive from now on. But the forward PE of a 72 does certainly make this one a tough buy. I love the whole brokerage industry. I actually own Robinhood stock. I own Futu stock, which is Moomoo. I own Moomoo. I also love Futu stock. I own SoFi. I own Dave. So, what is this right here? NVIDIA good stock to buy now? I think so. The 19 forward PE on NVIDIA looks very inexpensive. What about NXE uranium play? Okay, so Next Gen Energy. Let's check it out. So it's a Canadian company. Oh yeah, they look identical to the uranium ETF. So yeah, this definitely is a uranium company. We'll convert the currency to US dollars from Canadian just to get a better idea here. Okay, so this is a revenue-less startup. We go to revenue right here. It says no data because they're a startup. They've never sold anything before, not a product or a service, so they have no sales of revenue. And dang, look at these losses. And this is in US dollars. They lost 100 mil this quarter, 32 mil, 90 mil, 60 mil, 40 mil. In my opinion, these are not the kind of stocks I like to own, the revenue-less startups that lose hundreds of millions of dollars. That being said, this stock will probably just follow whatever. Like you see this chart right here, it looks identical, just the whole uranium sector, which is the URA, it's the uranium ETF, almost identical looking chart. So it follows the momentum of the uranium industry, but out of all the uranium stocks, it's definitely a tough sell as one with no revenue yet. All right. I have two great ETFs for you, DRAM and HBMX. Oh, we looked at DRAM earlier. Let's check out HBMX. I've never heard of that one. So this is the Total Capital Memory Stack ETF. Okay, so if you don't know which memory stock to buy, like there's Samsung. Oh, so they don't break it down yet. Um, but yeah, that's basically the same thing that a DRAM does. If you don't know which memory stock to buy, you've heard of this RAM shortage, and you're like, hey, do I want to buy Micron or SanDisk or Samsung? Well, this ETF just breaks your money up for you into all of them. So basically, you're investing in the whole entire sector as opposed to just one individual stock by buying that. All right, what's up, Yak? He says, what's your opinion on PRGO? Huh, Prigo. Hey, we just looked at Nokia stock. Tech looks choppy, possible July pullback. Hey, yeah, I'd believe it if that happened, but I'd love a pullback. That just gives us the chance to buy stocks and lower, especially with the market how it is. Now's the time to have a little extra dry powder on hand. Don't leave yourself with no cash. Don't spend all your money buying a stock. Like right now, I've been buying stocks. Like I want eventually Netflix is like 3 to 4% of my portfolio. I'm not making it 3 to 4% of my portfolio today, especially with how volatile the market is. So anyway, here's PRGO stock. Dang. Unfortunately, if you've ever bought this one, you're down on your money. So they're at an all-time low right now. Usually it's explained by the fundamentals. Let's see if we can figure it out. So they're in self-care, specialty care business. They missed on revenue this quarter by a big chunk. Dang, that's not good. Okay, so yeah, revenue. So yeah, this looks like a food stock or something. This is not what you want to see. The lifeblood of the company, the sales, the revenue. It's actually in a negative. Like, definitely worse than inflation. It's down 7% year over year, down 2, down 4, down 1, down 4. Like it's down 7% after it fell 3.5%. So let's go to their website. Maybe we can see what they do. To provide best self-care for everyone. Okay. What the heck? Why do these look so like headache tablets, hair regrowth treatment? Can't say that word on TikTok. So I guess this kind of stuff. They're headquartered in Ireland. Okay, so this isn't a US stock. They're headquartered in Ireland. Where does the revenue come from? Okay, so even though they're headquartered in Ireland, the US is still 60% of the revenue. Europe's another 37%. Anyway, I'd be very cautious with this one. Revenue's down 7%. Net income looks quite choppy. Like they just don't make consistent profits. Yeah, now I can see why they're at an all-time low. I would be careful with that one. I don't know. Should we wait for earnings or at least hyperscaler earnings before buying Innodata? Yeah. First off, this is one of my favorite stocks. I do own them. It's like as part of the software sector. Their main customers are literally Google. It's the Mag 7, X, Tesla, Apple. So Microsoft, Google, Meta, Nvidia, Amazon, they're all customers. The reason they gapped up this day is because they announced Palantir as a customer, and Palantir is now going to spend $50 million a year. It's a data labeling company helping companies train their data and LLMs. And I love Innodata with no net debt, crazy good growth. And I think the analysts are just wrong about this one. So this quarter specifically was amazing. They have an updated future analyst. This quarter, they projected 2.8 million net income. They did 14.9. And I bet you're wondering, was that some accounting fluke, one-time adjustment? No. They expected 3.6 million of EBIT, earnings before interest taxes, and did 16. And even on revenue, they expected 76. They did 90. It was a real organic beat. And I think if they beat this big on this quarter, they're going to be big the next couple quarters as well. So when they say they're at a 70 forward PE, I'd probably say they're at like a 50. But even at a 50, it still makes the risk to reward tough. That's still a little bit expensive, even on this slight downtrend. And I bought this one a while ago. It's not one you want as a meaningful size position, but maybe still as a position when it gets lower. But I'm still up 120% on my Innodata shares. I only have 10 shares, but I made it as a small position, and I'm just letting it grow to a big size position. It's a really fascinating company. I've made a few videos on them as well. I've gone over their investor presentation. Oh yeah, hey look, there's one of my old videos I made about them on here. Anyway, next up, let's see. Sold my Nebius on Wednesday. Hey, I think you must have sold it for a good profit. I'm assuming there, right? I agree. Now is a good time to have some cash on the side. Yeah, I agree. Wondering if a bad midterm could affect the tech stocks. Maybe. Whenever there's some short term like election or whatever, it's always a buy the dip opportunity, or it's been for all of history. Same with war fears. For every war fear crash in all of history, it literally has always for all of history been a buy the dip opportunity. Geopolitical fears, all that. Anyway, so someone said AMPX, Ampress Technologies. Let's check it out, Plasma. What's up, John? Oh, wait, John said that. Oh, my bad. So here's Ampress Technology. Sale of battery products. Okay. Look at the future forecast. That actually is really good. Revenue is going to go from 21 mil to 34 mil, and I noticed they always beat on earnings slightly. They are still losing some money, but I noticed if we go to net income forecast, they're only going to lose 3 million and then 1.5 mil. That's basically losing nothing. Like you're so close to break even at that point, but maybe in 1 to 2 years from now, they will be net income positive. I know this might be kind of a commodity though, battery packs and battery systems. Let's see, are they like Ampress secures a repeat $35 million purchase from leading UAS manufacturer. What is this here? So here's kind of here's their selling point. So 80% charge time in 6 minutes. We need that technology in our phones. 100% longer running time. I guess it can operate in a wide operation of temperatures from negative 30 degrees Celsius. Anyway, some sort of battery company that's maybe helping out the defense sector, like drones with their batteries. Hey, Flacito, man, what's up? He says Taiwan Semiconductor. I'm glad you said this one. I freaking love this stock. What's up, John? We'll look at VUZI, some of these other ones. A lot of companies based in Dublin for tax purposes. Oh, a lot of companies are also like headquartered in the Marshall Islands and just to pay no taxes. So here's Taiwan Semiconductor. Basically, NVIDIA is their biggest customer. NVIDIA just designs their chips. Taiwan Semiconductor is the one that actually manufactures them. Also, their number one customer is NVIDIA. Their second biggest customer is Apple. Taiwan implements a 5 to 10% price increase across advanced process nodes from 3 nanometers to 7 nanometers. Wow. So they're raises price target on server CPU manufacturing outsourcing growth. Yeah, the CPU to GPU ratio is going crazy now. So basically, it used to be for every 7 GPUs, you need 1 CPU in a data center. Now it's for every 2 GPUs, you need 1 CPU. Also, basically, this is the main manufacturer of chips in the world. But as we know, a lot of chips are manufactured, in Taiwan. So what they're doing is they're moving a lot of their manufacturing to like Phoenix, Arizona, bringing US manufacturing. But I believe this is a great stock to buy and never sell, especially if you can get it in on a dip. But even at all-time highs, here's why if I was a shareholder today and I was up a bunch, I would not trim or sell a single share because even at this all-time high level, they're at a 26 forward PE. That is very fair. That's not some peak bubble valuation. They trade at 26 times next year's net income. Very fair. Here's their market share, 72% market share. And if we go to look at the forecasted net income, and this is in US dollars, in 2 quarters, Taiwan Semi is going to make 21.2 billion in net income. Net income has never been close to 21 billion before. This was already a record. Record quarter this quarter is 17.9, but the EPS and net income growth is not done. It's still growing to 21 billion 2 quarters. That's why you value this one on a forward PE. And when we do, again, a 26 forward PE, that's like what the S&P 500 trades at. And for the growth that they're experiencing, like revenue's up 40, net income's up 60, the pricing power, and the additional pricing power they're about to have by raising prices again, CPU manufacturing tailwind, I really am a big fan of this stock. I'd love to own them. I wish I could just get them in a little lower. All right. I know Intel, there's also the seats that like Intel is another huge beneficiary because a lot of our chips are produced 10 feet away from China and Taiwan. A lot of companies like NVIDIA, Google and Apple have agreed to move some of their manufacturing to Intel. So that basically Intel and Taiwan Semi are the only like fab plays. Leopold's portfolio. Yeah, we can actually view that on here. That's what's kind of cool about this app. We can, all these super investors, if your net worth is over 100 million, they have to disclose every single trade that they do. So we literally get every single, she just bought a big call option on Intel and Uber. That actually sent Uber up 4% the day that was announced. Pelosi took a buy into Uber. But anyway, Leopold portfolio is full of these data center GPU renting stocks. Let's see here. Nebius is his largest holding. Oh, and SanDisk, Bloom Energy, CoreWeave, CoreZ, Iris Energy, APLD, Riot, CleanSpark, and Keel. They all do the same thing. Oh my goodness, dude. I would not own this portfolio. It is so exposed to GPU rental, and all these lose so much money. Nebius, CoreWeave, CoreZ, Iris Energy, APLD, Riot, CleanSpark, and Keel all lose a ridiculous amount of money. But his portfolio has done very well. Man in red, what's up, man? Yeah, AMPX is a cool little battery company. So let me do VUZI. I wanted to get to that one. Vuzix, cool. So Yeah, what's up, John? Unfortunately, this stock is not done too well. Dang, let me go to the monthly here. This stock is lower than they were in 2011. So you bought their $10 IPO in 2011. Well, the stock is $2 today. So it's definitely not kept up anywhere close to the S&P 500. So they do product sales, engineering, mainly in the US. So yeah, they're not net income positive yet. They're supposed to lose 8.6 mil next quarter, 8.7 mil the quarter after. Oh, geez, and the revenue's just so tiny. I mean, the revenue this quarter was literally 1.3 million. And it was down year over year, down 12% year over year. After that fell 21%. After that fell 52%. My goodness. I mean, it's just a tough one to trust. I mean, the company literally does a million of revenue a quarter. They lose 7 mil a quarter. What's the market cap? So when you're worth 227 million and you lose 8 million a quarter, that's actually starts to be a big issue. And now we have figured out why this stock has been flat, or it's lower than its 2011 IPO. Unfortunately, I would not buy that one. I mean, the revenue is just 1 million. If I'm looking for, anyway, there's so many great stocks. A lot of people only exclusively buy stocks that are on a massive dip, that are down like 50% the past year. Honestly, if you're looking for a stock on a massive dip, I genuinely believe one of the best stocks to buy is just Microsoft. They're on a massive downtrend this past year, and they have quality fundamentals. A year ago, they were 550. Now they're 370. All right. What's up, Nathan? Made some good money on LQDA since you mentioned it. Let's check it out. Since the stream a few weeks ago, you think it'll keep going? Wow, they are at a crazy all-time high. Yeah, congrats if you've ever bought this one. They're on my watch list, but let me remind myself of what they do. So they reported earnings and they gapped up, and they've just been up ever since. So let's see. They do product sales. Well, what do they sell? So they're a manufacturer of prescriptions. What prescriptions do they sell? Expertise in pulmonary hypertension. So maybe some lung, breathing, prescriptions like that. I don't know. Anyway, wait, do we get a pipeline and products? Okay. Our pipeline. So, you know what? I'm not getting anything good here. Let's just go look at their financials. So some sort of manufacturer of prescriptions. Whoa. Look at the revenue growth. This is why I put them on my watch list. Literally a year ago, who was buying this stock? The revenue was 2-4 million a quarter. It's basically nothing. Now, just this quarter, it's 132 million, up 4,000%. Like at this growth rate, what's it going to be the same time next year? And not just revenue on that. They did 132 million revenue and kept 52 million net income on that. And that was real after they paid 10 million of taxes. And see the net income forecast. Yeah, they're supposed to make 77 mil, 95 mil. I'm actually going to re-add this one to my watch list. Man, I am really impressed with this one. And they're only at a 16.6 forward PE even after this huge rally. I am definitely going to look more into this one. Jeez, those are some good fundamentals there. Hey, what's up, Josh? He says FDXF actually. Okay. So this is FedEx Freight Holding. Whoa. Did they spin this off? Was this a spin-off from actual FedEx? Less than truckload freight services. Oh, this is literally the business that Amazon is directly getting into. So basically, if you are shipping stuff, you don't use the whole truckload. You can rent half of the truck or something. You can fill up partial of a truck. And Amazon is literally now doing this exactly. This is the same thing that JB Hunt does, the same thing C.H. Robinson does, Schneider. So I don't know how I feel about this industry. Actually, there is one tailwind for this industry. For truck drivers, the U.S. administration is no longer allowing you to be a U.S. truck driver if you don't speak English. And in 2021, with all the supply chain issues, they were allowing people who basically didn't speak English to pass the test and become a licensed driver. Now they're revoking those, which actually could be good for FedEx. I know it's super good for C.H. Robinson and JB Hunt, but I now Amazon is literally getting exactly into this space, and I wonder if that's why they spun that off. Amazon Zoox unveils redesigned robotaxi. I love Amazon Zoox. Yeah, Amazon talks to sell TPUs. Amazon raises prices for GPU-based machine learning. Huh. Well, we couldn't find the less than truckload news, but I know that was a kind of recent sort of news. I think Samsung has a foundry, but it's small. Oh, hey. Thoughts on... Ooh, I am a little behind here. Spotify is a interesting subscription model company. If I was going to buy a subscription model company, first off, I'd rather buy Uber or Netflix because it's like all these subscription stocks are on a massive dip. I'd rather buy Uber or Netflix because Spotify, this one is more commoditized than the other ones. I used to pay for Spotify. Then when I got an Apple phone, they gave me 2 years of Apple Music. So I used Apple Music, was just as great. And then when I paid for YouTube Premium, it comes with YouTube Music. And YouTube Music has copied Spotify identically. So I just use YouTube Music and it has more songs. The bad part is Spotify doesn't own the music like YouTube does. Spotify pays royalties to Universal Music Group. And there's every time that Spotify raises prices, the people who put their music on Spotify basically ask for more prices or they threaten to take it off. So that's one of the bear theses. But anyway, we can see right here, they have 760 monthly active users, 480 million of those are ad supported, but the other 293 million are premium subscribers, and that's 91% of the revenue. This premium reoccurring subscription revenue. Also, they're the most profitable they've ever been. Like, it really is impressive. They're now making like 600, 700 million of after-tax net income a quarter. They are a European company, one of the European largest, but yeah, spinoff. Oh, okay, cool. So yeah, anyway, Spotify, look at the valuation though. This is the other part. They're trading at 30 times next year's net income. That might still be a little too expensive for some people. 30 times next year's net income, when you compare that to Netflix or even Google, which owns YouTube Music. It's still quality though. That's the thing, but I'm just kind of staying away from Spotify. Yeah, and it's a European company, so there might be some complications there. Livermore cautions against buying stocks in extreme dips, but it's hard not to be tempted. A lot of people, actually, I kind of disagree with that. A lot of people are dumb. It's psychology, actually. Most people think it's safer to buy a stock after they're at an all-time high. Like, it's safer to buy a stock after they keep going up, but that's completely wrong. Like, the actual safest time to buy a stock is when they're on a dip, but you always want to make sure it's quality, though, not some trash one. What's up? Oscar says, thoughts on RNA? What is RNA? Dude, no way. General Black, dude. Thanks for becoming a YouTube member. I greatly appreciate you, dude. Hope you're having a great Sunday, man. Yeah, also, I'm pretty sure you're already in the Discord, but yeah, if you become a YouTube member, you get permanent access to my Discord, or if you want to join my Discord, it just costs $1 to join. It's simply to keep bots out, but if you become a YouTube member, you get permanent access to the Discord. Even if you cancel your YouTube membership, you still permanently stay in the Discord. Basically, it's just a way if you have any questions to ask or anything or want any stock analysis. Yeah, link in the YouTube description to join the Discord. Or if you become a YouTube member, it's in the post, the community or member-only post to join. Anyway, enough of that. By the way, I sell nothing else. The only thing I technically sell is that $1 Discord. I sell nothing else. I have no course, book. I don't coach, literally nothing. Anyway, here's some stock, RNA. They're worth $225 million. Are you still on TikTok? Yeah. I'm streaming on TikTok and YouTube right now, but mainly YouTube because TikTok took down my stream, unfortunately. Yeah, if you're on TikTok, best way to support me is go to my YouTube channel called Nathan Robert. Just type into YouTube, Nathan Robert. So here's Atrium Therapeutics. This is a biopharmaceutical company that provides RNA services. So do they have revenue yet? They do have revenue. Okay, so this quarter they did 19 million of revenue. They still lost 16 million on that. Luckily, they have a good balance sheet ever since their IPO, so they can afford to burn some cash for a while. But these future revenue forecasts aren't good. They're only supposed to make 600K next quarter, 600K the quarter after. If that's accurate, then I'm kind of scared. And they're going to lose 20 mil. Again, I wish I could give you more thoughts on this company, but they literally just IPO'd. And again, when your whole company's worth 225 million and you lose when your whole company's worth 225 million and you lose 20 million, that's 10% of the whole company. So yeah, those microcaps were 200 mil. I would be very careful with. What does MLI do? That's Moeller Industries. This is my newest purchase out of any stock ever. This is my most recent purchase in my Webull portfolio. 10% of the market cap is their cash on hand. They're a $14 billion company with over $1.4 billion of cash on hand. They're trading at a 16 PE ratio. They do piping systems, industrial metal, and climate. They basically have these patented like valves for HVAC. But look at this right here. They had a great quarter. Orange line's what analysts projected. They expected 1.1. They did 1.19. And on net income, they expected 169. They did 239. And that wasn't some accounting fluke. That was a real beat. Even on EBIT, they expected 214. They did 312. And you get a dividend. They have a 1% dividend, 15% payout ratio, 10% of the market cap is cash. Anyway, I want to go to how do I get to their investor relation or investor? I'll be really quick about this. I'll show you what they actually produce really quickly because this is a really cool company and that's why I bought them. Okay, yeah, investor presentation. Here we go. So it's mainly like copper piping. That's most of the revenue. So global manufacturer of copper, brass, and aluminum products, exposure to HVAC, plumbing, electrical, industrial markets. That's why the stock has done so well. So anyway, 22% average return on invested capital, 19% total shareholder return on average, price to earnings multiple of 14.2. Yeah, literally zero debt, free cash flow conversion of 90%. So for every $100 that comes in, they keep 90% of that in free cash flow. Number one or number two in their core products and in key metrics. And here are all the kind of beneficiaries: fire protection, data centers, military and defense, all these sectors. So yeah, anyway, here's kind of like the margins. The climate has 30% margins, industrial metals a 10, piping systems is a 28% margin. They own the only Canadian like copper manufacturing plant. Anyway, I'm actually going to do a whole YouTube video. I could talk more about this one, but I don't want to bore anyone. And no, I have to go right now. No way, actually. Hold on. Yeah, I have to go right now, and that sucks because the stream is doing so good. Well, hey, if you did enjoy the stream, please leave a like. I sadly have to go. If you appreciate my analysis, check out my channel. Consider subscribing and hitting the follow button. I'm probably going to be streaming later tonight. I appreciate everyone that's here. Please hit the like and follow. I sell nothing. Again, watch out for people impersonating me. I sell nothing, no course book. Only thing I have is a YouTube channel. So thanks again to everyone on YouTube. Please hit the follow and like, and I'll see you later. And consider becoming a YouTube member. You get permanent access to my Discord, even if you cancel the membership, or if you just pay $1. You also get permanent access in the description. Anyway, I'll make a video soon about Moeller Industries. I'll kind of end this with a quick portfolio update. My most recent purchases have actually been Moeller Industries. That's the very top of the list because I just bought them. Oops. And I've also been buying Netflix, CF. I buy more Uber and Microsoft. I think all these stocks are a very fair deal. So yeah. Anyway, I do have some cash on hand. Yeah, if you look at my cash, I got $390 of cash. I will be looking for deals this week. So anyway, hope you have a great rest of your Sunday. I will be back soon, probably streaming